So guys, the next standard will be Ind AS 115. Conceptually lengthy standard, but see, if you are learning the standard for the very first time, you might find it theoretically a little heavy, but you see the questions are very easy. It's just that you understood the concept or not. Even though if you count all the questions that are there in StudyMat, RTP, MTP on this 115 till date, it will come to 110 questions or something like that. Small, medium, big, all put together. But in all that 100 questions, the number of questions where lot of numbers is there, amount calculation and all is there, hardly 5 or 6, max 8. Rest all are theory questions. Pure theory questions. Just have to write the principle, say how much revenue you have to recognize or whether you should recognize or not. That's it. So don't get panicked looking at the size of the standard, number of the questions. No sir. Concept if you understand, I'm not saying that the concept you will apply and you will do some behave like scientist in the question and all. No. It's very straightforward. Very straightforward questions you will get. But concept you should be good with. Anyway, to start quickly. Sir, the standard title is Revenue from Contract with Customer. So, how much revenue we have to recognize, that 115 will tell you after understanding what you have written in your contract. So, what kind of contract our entity has entered in with our customer? Based on that, we will decide when, how much revenue has to be recognized. That's why, like AS name, we do not call it as revenue recognition. We are calling it as revenue from contract with customer. Now, there are two aspects now. One is contract, the other one is customer. Now, contract is must. If contract is there only, then only revenue can be recognized. And contract always need not be written contract. It could be oral contract also. The point of having a contract here is understanding or getting clarity on terms and conditions of job to be performed and making it legally enforceable to receive the consideration. For that purpose, contract must be existence. Right? That is the first part. Next thing. Customer. Who is customer? That is defined in the standard. Customer is that person or that party who has contracted with the entity to obtain goods or services which our entity provides normally in the ordinary course of business. For example, I am into the business of manufacturing goods. I have been doing this business last 15 years. My plant and machinery became old. So I want to buy a new one. So to sell this old one, I entered into a contract with you. I will sell the machinery to you and you will take the machinery and pay me money within next 15 days. So whatever you are paying me is definitely amount. Agreed. But you will not become my customer. There is a contract also. There is a sale also. But you are not my customer. You are a person who is buying my PP. This is not something which I sell in the ordinary course of business. So who is customer? Defined here. See there, a party that has contracted with an entity to obtain goods or services for consideration. And these goods and services are output of entities' ordinary activities. Our ordinary activity ka output, whoever is buying, that fellow is called as customer. Next. This entire standard operates on a 5-step model. The 5-step model is, first we will understand the terms of the contract, identifying the contract. That means whether whatever contract you have, is this contract in accordance with the provisions given under Ind AS 115 or not. As well, first of all, revenue recognition framework law, is this contract there or not, we will establish. The entire objective of first step is, can you recognize revenue or not? We will decide now. How much, when, all that questions we cannot answer in step 1. Step 1 ka ultimate objective is whether can we allow you to recognize revenue or not. That's it. Step number 2. Identifying the performance obligations. Now that you entered into a contract with your customer, towards customer, what obligations do you have? What duties, what promises did you make to the customer? The promises are referred as performance obligations, provided those promises are distinct. Now, what is the meaning of distinct? How a promise becomes a PO, performance obligation? All that we will study in step 2. Very small step, but among all the 5 steps, most important step is step 2 only. In terms of number of questions, may not be very high. Number of questions will be high on step 3. Step 3, lot of questions are there. But step 3 is extremely easy. step 2 is dangerous. Come to step number 3, it is determining the transaction price. If I give you goods or services, for that, how much revenue I am going to receive. That is called as transaction price. So how to measure? In that again issues are there. If it is variable consideration, how will you do? If you get non-cash consideration, how will you do? If our entity only is paying money to the customer, how will you do? If there is a time value of money gap, interest income, interest expense, how to account, all the discussions are there. Very interesting. Next, in step number 3, whatever overall revenue number you identified, amount, transaction price should be allocated to the duties what you observed in step 2. That means allocating transaction price to performance obligations. Step 3 should be allocated to step 2. How to do that allocation? Step number 4 it is given. Finally, revenue recognition ka timing. So when you can recognize revenue, how much you can recognize revenue? Step 3 we discussed. If there are multiple duties, each duty how much is the revenue? Step 4 we identified. Now when to recognize revenue, our timing point is discussed in step number 5. When you read step number 5, they will say that revenue is recognized when control over goods and services are transferred to the customer. And control, how it can be transferred, there are two ways. Either over a period of time or at a point in time. If control is transferred over a period of time, revenue also will be recognized over a period of time. If control of goods and services to the customer is given to him at a particular point in time, revenue also will be recognized at that particular point of time. That's all. Broadly, these 5 steps. Individual steps, as we go deep, we'll understand more issues. Let's come to the first one. If the contract has to be within the framework of Ind AS 115, it must satisfy 5 conditions. First condition, the parties to the contract must approve the contract. That means a contract should be properly approved by both the parties with no uncertain terms. Next, the parties' right to goods and services must be identified. When I have to deliver goods and service, and at what point of time you will get right on these goods and services, on the terms of delivery, terms of transfer of control must be clearly established in the contract. Number 3, payment terms are established. Meaning what? For these goods what I am giving, how much money you will pay, how much you will pay now, or will you pay it later, will you pay along with interest or partly now, installment, payment terms must be established. Point number 4, the transactions should have commercial substance. What is commercial substance doing in this? Imagine, sir, I am having, let's say I am into oil business. You are my competitor, you are also doing the same business. My sales are less, your sales are also low. We both are sad, but we both decided that we will do something and increase our revenue. What is that? We both enter into a contract that every month I supply 100 tins of oil to you. In return, you will pay me consideration in the form of your branded oil to me. Every month I sell oil, consideration, instead of giving me cash, you will give me your oil as consideration. If you technically observe, is there a sale? Yes, there is a sale. For the sake of it, there is a sale. Am I receiving some consideration? Yes. But is there any commercial substance? No, because what I am giving and what I am receiving both are same. There is no commercial substance. If I agree to account this as revenue, what will happen? Both of them will nicely increase their top line revenue. Inventory lo change will not be there. Profit lo change may not be there. But top line revenue lo sales will increase crazily. If commercial substance is not there, revenue should not be recognized. That is 4th point. 5th point is, whatever consideration is there, a consideration collection should be probable. On first day, as an entity, I should have probability that I will recover the consideration due from the customer. If all the 5 points are satisfied, then only you have a valid contract as per Ind AS 115. Don't misunderstand that if all the 5 points are satisfied, I can recognize revenue now. No. When to recognize revenue? Why will I tell you that in step number 1 only? That you will know when we come to step number 5. Step number 1 you will never know how to recognize, when to recognize revenue. We are only talking whether the contract what you have in hand, is it a valid contract or not. Chalo sir, I have a valid contract. So what? Then I will take you to step 2 now. That's all. But wait. Sir, what if one or more of these 5 conditions are failed? The standard says, don't apply any further steps. You cannot recognize revenue. If any of these 5 points are not satisfied, revenue recognition is not permitted unless you fulfill all the 5 points. But if I fulfill all the 5 points, what will happen? Then I will ask you to move to further steps. That's all. When to recognize revenue? 5th step, liability. Clear, sir? Sir, you know what? If 5 points or 1 or 2 points I did not satisfy, sir, but that customer fellow already paid me money. So bank account I debited, sir. Credit where? You have to create a liability. It's simple, sir. You received money. If it is not income, there is no option. It has to be paid liability. Credit accounts are what, sir? Only 2. No, it should be either income or it should be liability. Standard says I'll kill you if you create revenue account. Then I don't have a choice. I have to recognize it as a liability. So any of these 5 conditions are not satisfied, you will not recognize revenue. Whatever amount you received should be recognized as a liability. Whenever we establish a rule, this fellow comes up with the exception again. There are 2 exceptions to this rule. What are 2 exceptions? First of all, exception ka meaning is what? Even though conditions are not satisfied, still you will recognize it as revenue. 2 cases. Case number 1. Sir, look at this. I am building apartments. You came along with your family to see the apartment. It's under almost in final stages. I'm very busy. You came and negotiated. I told a particular price. You said that, sir, you are asking 2 crores. First, I will pay you 5 lakh rupees. Reserve this flat for me. I will go and start loan formalities and all. Within 15 days, I will come and I will pay 50% of the amount as advance. I said, okay, no problem. But in the next 1 month, if you don't turn up, whatever amount you are paying me today, that amount will be non-refundable. Contract is cancelled. We will allot this flat to some other customer. Moreover, whatever amount you are paying, that will not be refunded to you. Okay. But I know that the customer is not going to come again. The sale will not happen. I don't have any probability that the sale will happen. So, on the safe side, what I did is, I recognized it as a liability. 15 days over, 1 month over, customer did not come back. I called up the customer, Babu, what happened? He said, sir, my loan is rejected. They said that my civil score is not good enough, I won't get loan. So, I will forego this amount, 5 lakhs. Kindly sell it to somebody else. Sorry for inconvenience, customer walked away. So, from my point of view, see, bank account debit to liability I created day 1. Contract is terminated already. Whatever amount I already received, that is not refundable also. That's a pure gain for me. Happily call it as revenue. Are you understanding, sir? You should not say that, ask him to somehow fulfill all the 5 steps and all. He does not want to buy. Okay, so when the contract got terminated, that amount is purely gain. Recognize it as revenue. Case 2. Case 2 is, I entered into a contract to deliver some 10 shirts to a politician every month. Example, 10 shirts, white shirts to politician every month. Like that for 1 year. First day I know, this politician fellow has caught me. I can use him from advertisement and all. This fellow buys from our shop, only one photo in our shop. All this is okay. But money, I can't ask him. If he pays, I will take. That too first time, no sir, I will say. But ultimately I want. I will take. But that bugger should say no. He should pay no first of all. And I can't fight with him. I can't put a police case on him. So, first day he paid me little amount. I delivered 10 shirts. Fine. Next month, again 10 shirts. He is not paying money. Third month again delivered, not paying money. That means, I know that he will not pay me money. But I can get some favor from him in future. But for the goods what I am delivering, revenue is not going to. So first day he paid you something, no sir. Or something cannot be recognized as revenue like that. That you put it in liability. Why sir? 5th condition failed, no sir. What is 5th condition? Collectability should be probable. For a shirt that fellow owes me 2,500 rupees. Per month 25,000. Per annum 3 lakhs. First day he gave 15,000 rupees. Do you think I'll call it as revenue? Bank account debit to liability. First month 10 shirts delivered, second month delivered, third month delivered. Fourth month, that fellow suddenly came, paid 50,000 and went away. God's grace. This is the last time I take money from him. But still you don't believe that he will come and pay remaining amount. Still fifth condition is not satisfied. Still fifth condition is not satisfied. So what will you do? Already 10,000 is in liability. If 50,000 also will go into liability. Sit there only. You keep on delivering shirts. 12 months over. E process of what is happening, 11th month or something, that fellow paid you almost 2,30,000 rupees at once. Firstly, he already paid some 40-50,000. Overall, almost 3 lakhs he paid. Now 12th month, last installment 10 shirts also delivered. From my side, are there any remaining duties? I have fulfilled all the duties, whatever I have agreed. And did I receive all or substantially all of the consideration? I may not have received the entire consideration which I want, but almost I have received. The standard says enough of liability. Recognize it as revenue. There are two cases in which you will recognize revenue now, even though some of the 5 points are not satisfied. First one, contract should be terminated, or the second case, contract should be completely executed. There should be no duties pending from our side. Not only that, consideration also should be received substantially or all the consideration. Then only you can recognize revenue. Clear? Next. This is a small story of combination of contracts. Combination of contracts means, see, there are multiple contracts entered by our entity with a same customer. Entity same, customer same, but contracts are various. There are 4 contracts entered between entity and the same customer within a span of 2 weeks. 2 weeks no 4 contracts, same customer. The standard is having only one small doubt. What is the doubt is, should I recognize revenue individually for each contract, or should I club all the contract, treat them as a single contract and then recognize revenue? So should I give them independent status or should I club them? If you say you should club them, that is called as combination of contracts. Sir, why are you bothering, sir? Anyway, answer will be same. No. Imagine, customer gave me construction contract of 4 buildings. Okay. Since it's a construction business, most likely revenue recognition is based on degree of completion. Correct? So, for each construction work I have to work out degree of completion. If there are 4 contracts, if you ask me to work out degree of completion individually, each contract I have to work out. If you ask me, no sir, even though legally there are 4 contracts, in substance, all 4 buildings put together is one big factory we are constructing, sir. That's a single asset only. Then I have to watch degree of completion from overall point of view, factory point of view, not individual block point of view. Are you understanding, sir? So it is very important whether you analyze these things at individual level or combined level. So the standard says we are giving you 3 criteria. If any one of the criteria you pass, then all the contracts are clubbed, treated as a single contract. Number 1, the contracts have been negotiated as a single package. What is the meaning of contracts negotiated as a single package? FR fee is 10,000, AFM fee is 10,000, audit fee is 10,000, but all 3 you take at our institute only, we will give it for 25,000. You agreed. So here I am selling all the 3 services as a single package. In this case, that means if price is negotiated because I'm accepting all the orders of the customer. Our customer says, all 4 buildings I'm giving to you, do it for a consolidated price. Give me some discount. I agreed. Overall basis, I agreed. In that case, standard says club it. Case 2. The consideration payable in one contract is interlinked with the performance in another contract. This is a manipulation case, sir. If you try to do manipulation, standard says, I will not let you do. Quickly I will tell you if you understand, sir, others don't worry. There is no question on this. Sir, A, B, C, 3 buildings have to construct. What I wrote here is fair value. This is 300, this is 200, this is 100. In fair values. This will take 1 year time, this will take 2 years time, this will take 3 years time. Total 600 crores customer will pay me. I am entity, customer will pay me 600 crores. I want to manipulate my profits. I want to show high revenue in the first year. What I told the customer is, customer will make a small gain. For you, it doesn't make any difference. I told, what is that gain? Contract price is recorded like this. 100, 200, 300. Customer says, I don't mind, anyway I have to pay you 600 crores. So even if you write like this also, I don't have a problem. What is your idea? As an entity, my idea is, building C, construction will take only 1 year. So I will first finish off building C. Normally I could have recognized only a revenue of 100 crores. But because of this manipulation, I can easily recognize how much crores? 300 crores. Can I manipulate now? Yes. E idea. That is the reason I manipulated the prices. Now, customer says, I don't have a problem if you write like this, but don't ask me money. Customer is not stupid, no sir. Customer says, if you want to write that, write, but don't ask me money. The moment you finish C, I will pay you 100 crores. There are remaining 200 crores. Whenever you finish A, I will pay you that. Customer is also smart, no sir. Otherwise, what will happen? You will nicely finish off C. Later on, terminate the contract. After receiving 300 crores. That fellow is not stupid, no. He says, you manipulate price, but don't ask me payment. You ask me payment of C 300 crores, I will pay only when A is also complete. Customer is also smart. If that kind of thing is visible anywhere, no, identify. That is a manipulative game. In that case, standard says, shut up, club everything. There is a single contract price is 600 crores. Clear, sir? Third case. I have to construct a gas chamber like this. Here also one plant I have to construct. Here also I have to construct a plant. Plant 1, plant 2, plant 3. 3 plants I have to construct. 3 contracts they have awarded. In all contracts, what they wrote is, first plant and second plant should be integrated, second and third should be integrated, and if first will take input of crude oil, this will be capable of giving refined petroleum. That means they are asking me to construct a single asset called as oil refinery. Instead of writing a single contract, what did they do? For each plant they wrote a separate contract. The standard says, even though there are legally 3 contracts, all the 3 contracts put together in substance represent a single performance obligation. Okay, assembly line we have to construct. Put raw material there, finished goods will come up at the end of third process. The entire thing you are giving me, this is a single PO, single performance obligation. So legally there may be 3 contracts, but treat it as a single contract for the purpose of revenue recognition under Ind AS 115. That's also, that is all. If any of these 3 you find now, combine the contracts. Clear? Next. Step number 1, last aspect is contract modification. Contract modification we will talk when we finish off step number 5. Okay. Now at this stage we cannot discuss contract modification because contract modification, if you have to understand correctly, you should understand the meaning of performance obligations very clearly. So PO ka meaning only will come under step number 2 now. So timing will pause it, will come back in a while. Come to step 2. Step 2 is identifying performance obligations. Now, performance obligation at a very basic level is, whenever an entity enters into a contract with the opposite customer party, entity will agree to do something, I will promise something. Our promises are called as performance obligations, provided those promises are distinct. The standard uses one very important term called as distinct. So if a promise to deliver good or service, if it is a distinct, then that promise will attain the status of performance obligation. Now, just for the sake of it, once go through the definition. Performance obligation is promise to transfer goods or services that are distinct, or series of goods or services that are substantially same and have the same pattern of transfer are also treated as a single performance obligation. What is all this we will see. Now, even though entire step number 1 we are talking about contract, Ind AS 115, sir, revenue recognition will not happen at contract level. It will happen at performance obligation level. Sir, what is the meaning of revenue recognition happening at PO level? Simple. I agreed to sell air conditioner to you. That's the first promise. Promise number 2. I agreed to do free maintenance service for the next 1 year. Every 3 months our person will come clean the AC and go. Then I gave a warranty that there will be no problem in the AC for the next 5 years. If anything happens, free repair. So how many promises are there? 3. 1, sale of goods, AC itself. Number 2, service maintenance contract. Number 3, warranty promise. Did I make 3 promises? Now, revenue recognition is not done on a contract level. A contract price, whatever is there, that you will allocate it to all the 3 promises. First promise ka revenue separately recognized, second promise ka revenue separately recognized, third promise ka revenue separately you have recognized. That means if promise, you have to first prove that those promises are performance obligations. If you prove that it is having the range of PO, then I will allot some consideration toward that in step number 4. And step number 5, we will talk about revenue recognition for each PO, not for the contract. Nobody will write that e contract revenue recognized, not like that. E PO recognize revenue at this point of time. E PO recognize revenue over a period of time, like that. Am I clear here? Revenue recognition happens at PO level. Next. Now, what is the meaning of the word distinct? This, if you understand, step number 2 is over. 115 will become extremely simple for you. If you do not understand this word distinct, your life in Ind AS 115 will be very, very miserable. If somebody hates 115, that's only because they don't understand the term distinct. Now, before we actually learn the term of the, meaning of the term distinct, let me put something very clearly. Distinct means, from your mind, remove the word different. What is the meaning of the word distinct means? Different and a word, remove it from your mind. It is not that. It's not that. And then distinct means what? I will tell you official part, but for quick understanding, you may understand it as independent. Distinct means you understand it as independent, not different. Okay? Now, come to the next page. Promise to deliver goods or service. Every promise will become a distinct promise when 2 conditions you have to satisfy. What are the 2 conditions? First one, each promise to deliver good or service is capable of giving benefit to the customer on its own. If I agree to sell an AC to you, is AC alone capable of giving you benefit or not? Yes. If I do maintenance services, is it capable of giving benefit to you or not? Yes. If I give you warranty promise, that also is capable of giving benefit to you or not? Yes. That means what? Each promise I made in my contract is capable of giving benefit to the customer. The first point. Second point, when there are multiple promises in the contract, each promise must be separately identifiable from other promises. Each promise must be separately identifiable from other promises. The second criteria is obviously common sense. It is obviously applicable when there are multiple promises. If there is only one promise, for example, sir, you paid me fees 10,000, sir. I told that I will teach you a FR class. How many promises there? No promise. But if I tell you that for the fees what you pay, I will conduct entire FR class. I will give you books also. I will take care of all the exams. I will ensure that you stay here only. I will provide reading room facility. I will mentor you and put exams. I will see through that you pass the exam. How many promises are there? Multiple promises are there. In multiple promises, if they are there, then each promise will become a distinct promise when one promise is separately identifiable from other promises. Okay, sir, separately identifiable, understood. But separately identifiable, and how will I prove? How will I know when I read a question? For that, standard negatively treats it. There are 3 criteria. If any of these 3 are there, then separately identifiability test is failed. Or you can understand it positively. If separately identifiability criteria should be passed, none of the 3 boxes should be satisfied. Now, let's see examples and then we'll come back and read this. Okay? Example is, suppose I am X Limited. This fellow is a customer. Customer comes to me and tells me that, sir, you have to construct a residential villa and give it to me. I said, okay. We entered into a contract. In that contract, what I promised him is, I will use a particular kind of cement in construction. This quality, this grade cement only I will use. I promised that. I will use a particular kind of raw material. I will bring labor who are experienced. I will get your house cut design from a particular architect only. Not local contractor and all, proper architect too, I will make it design. I will ensure that this is Vastu compliant. I promised that I will use a particular kind of Italian marbles for flooring. Then a proper interior I promised. So over 25 promises I made. But all 25 promises are going to be executed independently, are ultimately designed to give a single combined output. Single combined output. All these 25 promises are ultimately integrated into one combined output, which is a residential villa, isn't it, sir? The moment you are promising integration, that means indirectly, you know what you are saying? The benefit of this, the benefit of this, the benefit of this, this individually customer will not enjoy. Imagine, sir, I bought cement, whatever I promised I bought, that is there on the site. Sand is there, 20 labor people are sitting there, design papers are flying everywhere in the site, marbles are there. I told the customer, see sir, customer, I told you 25 promises, all 25 promises are on the site, give me my money. Will the customer give a? No. When will he give? You integrate everything, construct a house, then ask money. Just because you fulfill these promises independently, money will not earn. Money, when will it come? Only when you integrate them. The moment you are saying that you have to integrate them, that means indirectly you are saying that e-promises are not separately identifiable. Multiple promises combinedly are treated as a single performance obligation. Clear, sir? If significant integration is there, separate identifiability test will be failed. You have to club all the promises into a single PO. This is first case. Case 2. I am a company. To a customer, what I promised is, I will provide him with the software what he is asking me. Then I will only come and do implementation. Any technical updates and all that we will give it, and technical support also. Technical support means if any problem comes, we will come and handle it. For all the 4 promises, he is paying me an amount of 10 lakhs. The customer took all 4. But I already told the customer that even though I am giving you 4 promises, you can choose to take few also. That means you buy software and implementation from me, updates you can buy separately later if you want. Or if you already have, you yourself are capable of supporting yourself, then don't take technical support, take only the software. Like that independently offer is there. But still the customer chose to take all the 4 from me only. Ideally speaking, if no information is given, 4 promises should be ideally 4 POs. But I am telling you one case. In the course of implementation of software, the software has to be modified significantly. Indirectly, what I am trying to say is, whatever software I am selling to the customer, our software is not final software. That is basic version. Remaining software ka coding has to be written in the course of implementation. Every software is not easy to install, sir. Installation sometimes will take months and years also. A customized ERP software you want, it will not happen in 1 or 2 days, 1 month. It will take months, sometimes years also, ERP software installation. We will buy package from Oracle. But that Oracle ka package has to suit your company ka requirements, no? Who will do that job? Oracle will send team of experts, they will sit in your office and write the coding for your designed requirements. So software base is there, for that further software modifications have to happen. That means what? The promise to implement the software is going and significantly modifying another promise called as software. When that level of modification is happening, the standard says where are they separately identifiable? Not because you are not merely doing implementation work, you are doing implementation work also, modification of software also. When this kind of things are there, when one promise is modifying or customizing another promise, then separate identifiability test is failed, which means the answer now is these two put together are treated as one PO. This is one PO, this is one PO, this is one PO. Total there are 3 POs. How many promises are there? 4 promises are there. But how many POs are there? 3 POs are there. So first exception you have already seen. What is that? If integration is there, gone. Second one is what? If one promise is modifying the other promise to deliver goods and service, then these both are combinedly put together to be treated as a single PO. Clear, sir? Then there is a third one. What is the third one? Imagine, sir, there is a hill. On this hill, there is a temple. Okay? Lot of pilgrims go to the temple. There is no way where vehicles and all can pass there. So people are literally going through that hilly forest area only to the temple. It's a risky place. There is one government who promised that you elect us to power, we will construct easy way to that temple. People trusted, government won. Our government gave contract to us. Now we have to draw and design and construct a rope car facility to the temple. This is the normal area where road and all is there. This is all forest. This is a temple. So from here, we have to construct a rope car up to here. Designing also I only have to do, construction also I have to do. But I have a preliminary design. But whether this design will work or not, I will know only when I start constructing. What we will do? First design I did. Actually, so how many promises are there? Prima facie 2. One is designing, the other one is construction. 2 promises are there. First I design. I will go and see if this is working, construction will happen. In case construction is not stable based on this, immediately I have to come back, alter the design, throw all the work done till now outside, again start doing construction. Do you agree that construction is dependent on design? In my case, design is also dependent on construction. Why? This is not constructing house, no sir. This is constructing a rope car in a hilly area. I should not do something which will crash that mountain and temple also. So I have a design. Based on that I will start the work. If the work is not holding good, design I have to scrap, start again. That means I have 2 promises. Each of the promises is highly interrelated or interdependent on one another. If that kind of interdependency is there, with what face will you say that it is separately identifiable? It is not separately identifiable. So there are 3 cases where separately identifiable test will fail. Number 1, the moment you promise significant integration. When one promise to deliver goods or service is modifying the goods or service in another promise. Second case. Third case, the promises are highly interrelated or highly interlinked. If you don't find any of these 3, that's all. Your promises are separately identifiable. The moment they are separately identifiable, your promise will go to the level of performance obligation. All. That's all. In every question, wherever, whether it is a PO or not in a question, whenever it comes, no sir, you have to ask yourself reverse question. A question of search. Is there significant integration? Is there highly interrelated interdependency? Is one promise modifying the goods and services in another promise or not? If these 3 are not there, khatam sir, they are distinct. You understand sir? Each promise should have their independent worth on their own without getting linked with nobody else. Then the promise will become PO. Clear? Now, next, in this only one more small case. Okay, once read this and then I'll tell you the small case. First one is each good or service is capable of giving benefit to the customer. Second condition is each promise to deliver good or service is separately identifiable from other promises in the contract. Relating to this, what I wrote, promises are not treated as separately identifiable if any of the following factors exist. There is a significant integration of goods and services to deliver a promised output. Construction of a house. Promise to deliver goods or service significantly modifies goods or service in another promise. Installation, implementation of software is modifying the software itself. Third one, the promises are highly interrelated or interdependent on one another. Construction is based on design, but design is also based on how construction is progressing. High interrelation is there. Then read next line. If goods or services are not distinct from other goods or services, then they are all combined into a single PO. You see 25 promises relating to house construction. Did we club it into single PO? Design construction, we clubbed off. Software implementation, we clubbed off like that. Clear, sir? Now, next case. Guys, I subscribed to, so let's say I am Netflix. You subscribe to Netflix. You paid me 1,000 rupees. Okay, why 1,000? Let's say 1,200 rupees. Or let's say 3650. Very easy for me. So per annum subscription you paid me 3650. So indirectly per day you paid me 10 rupees. And no sir, is it 999 only? Shut up. Just example. So 3650 you paid me. Now, how will Netflix recognize this as revenue? What is the promise I made? I will give you access to all the content in our OTT platform for the next 365 days. Correct? How many POs are there? Okay, how many promises are there? Only one promise, sir. In one promise, what did I give you? I told you that I will give you access for each day of entire 365 days, 24/7, wherever you are in the world. You travel, no, sir. So, there are 365 days ka access given to you. 365 promises are there. How many POs are there? Promises are 365, can't. I may write in single line. Will I say I will give it on Jan 1st, Jan 2nd, like that I will keep on writing throughout there. So 365 days ka access is there. 365 promises are there. There is no doubt in that. How many POs are there? One PO, 365 POs. One PO. You are saying that 365 promises are there, but it is all put together a single PO. If you are saying that, you know what? Indirectly you are saying that each promise is not separately identifiable. You are saying that. If you are saying that each promise is not separately identifiable, you have to prove me that there is significant integration. You have to prove me one is highly interrelated, interdependent on one another. You have to prove me second day of you watching Netflix modifies your watching experience of day one. Will you fall into any of these three criteria? No. Which means they are separately identifiable. 365 promises are 365 performance obligations. There is no doubt in that. 365 promises are 365 performance obligations. You know, ideally what should happen? 3650, let's say it's what I collected from you. Per day I collected 10 rupees. At the end of each day, I should sit and write revenue 10 rupees, 10 rupees, 10 rupees. And every day passed, I should recognize the revenue. This is ideally correct answer. But imagine. You took the subscription on January, paid me money on January. I am closing my balance sheet on 31st March. Instead of writing entry on a daily basis, is it not convenient for me to write entry directly on the balance sheet date? Total 12 months, no? 3 months service I delivered. So 3 months ka revenue I can recognize. Directly, is it not convenient for me to recognize entry directly on the balance sheet date? Instead of recognizing daily entry, right? Whatever standard gives a convenience is if there is series of distinct POs which are having same pattern of transfer, then you can treat them as a single PO and recognize revenue over a period of time. This is convenience provision. Don't wrongly understand. 365 promises, 365 performance obligations. No sir, I don't want to do like that. I will recognize revenue daily. Recognize. Happily you can recognize. But nobody will do that. The people will recognize over a period of time. Instead of recognizing revenue every day, they will directly recognize on the financial statements ending time, depending on how much work is done. Suppose you paid to these days, milk and all, there are corporate companies who are entering. You subscribe daily basis, they'll come and deliver milk to you. Subscription annual package. You paid money to them. Do you think that after each milk packet they'll sit and write revenue entry? Yeah? No. But you observe, 365 POs are there in that. First day they delivering milk packet, second day delivering milk packet. Separately identifiable, integration is there. Highly interdependent. Second day milk modifying, first day milk. Akka separately identifiable. 365 promises, 365 POs are there. But the goods or services in each promise are substantially same. The mode of delivery same. The standard says treat them as a single PO which is getting satisfied over a period of time. So instead of recognizing revenue daily, directly on the balance sheet date you recognize. By balance sheet date, 6 months is over, half revenue recognize, remaining of next year you will recognize, like that. Are you getting it, sir? Turn back to the previous page. Now read. A performance obligation is a promise to transfer goods or service that are distinct, number one. Number two, or a series of goods or service that are substantially same and that have the same pattern of transfer to the customer. Therefore, the entire series is treated as a single picket. Students, look at this. Distinct goods and services telling no. The moment it is distinct, this is very PO here itself. But this is not single PO. The series of POs treated as a single PO. Are you understanding what I am trying to say? On this question, sir. So this is the smallest step among all five, and this is the most dangerous step. Whenever we use the word distinct, in your mind what should flash? Separately identifiable, and a word should flash. And you happily treat it as separately identifiable if there is no integration, no high interdependency, no significant modification or customization. Khatam. That is separately identifiable. Clear? Guys, this is about step 2. Coming to step number 3. Step number 3 is lengthy among all the steps, but it's very, very easy. Okay. Step number 3 is you determining the transaction price. Now, transaction price is nothing but the amount, quantifying the amount of revenue. Sir, in the contract, I tell the customer, you have to pay me so much amount. Customer also agree. That is called as contract price. But step number 3 heading is not contract price, because first of all contract should be existing. Step 1. If contract is existing, contract amount is also decided. Payment terms should be established and wording is there. It means what amount we know already. That is called as contract price only. But step number 3 heading is not contract price. It is transaction price. So transaction price need not be contract price. So what is transaction price? Transaction price means what you are expected to receive. Not right to receive, expected to receive. For example, I am teaching a class. My official price of the fees for the class is 10,000 rupees. Many people who come here will take some hostels and all, they stay here only, they attend the class. Since they just 2-3 days back only they came, they are busy and all. What our sir will say is, you need not pay full 10,000, pay half, anyway class will go on for 3 months, remaining amount later on we will take. So student paid 5,000. But our past experience says that nobody will pay 10,000. Innocently some people may pay, but everybody does not pay. We also do not ask. Officially fees is 10,000, postal will be 10,000 only. But on an average, we collect only around 8,000, 7,500 per student. So if you observe the difference now, contract price is 10,000, but amount expected to receive is 7,500. 7,500 is just transaction price. 10,000 is contract price. Revenue recognition will happen for transaction price, not for contract price. Read the first line. Transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer, excluding the amounts collected on behalf of third party. When I sell goods, I also collect GST, but GST is not mine. On behalf of auntie I am collecting. That GST, how can I keep? The GST is not my revenue. No, I will collect it. I will call it as GST liability payable. That is not my money. GST is not your revenue and all. Next. In this transaction price steps, total 4 issues are there. One is variable consideration, story. The other one is financing component. non-cash consideration, and consideration paid to customer. Total 4 issues are there. Let's come to the first one. First one is variable consideration. So the consideration what the customer pays us can be fixed also, variable also. When you say variable, what kind of variable? See, customer tells me that for constructing a particular power plant, he pays me 10 crores and he is giving me a time period of 3 years. But if I finish off 3 months before, then he will pay me some extra consideration. If I finish off 2 months before, some extra consideration. If I finish off 1 month before, some extra consideration. If I finish exactly at 3 years time, no extra consideration. If I delay it by 1 month extra, he will deduct the consideration, penalty he will put. That means some fixed component is there, but if I finish off the job quickly, he will give me some bonus. That is called as variable consideration. Similarly, if I don't finish the job on time, there may be a penalty also. That is also part of variable consideration. Then, another example I am telling. I told the customer that when the customer came to buy goods, he directly put an order for 10,000 units. I told the customer, sir, we are very happy to have a customer like you. The price is 100 per unit. Customer told, I am buying 10,000 units, still price is 100 only, can't you give me discount? Then I told the customer that, no sir, our scheme is like this. If you buy 0 to 10,000 units in a year, price is 100. If you buy 10,001 to 25,000 units, the price is 80 rupees per unit only for all the units. What I tell customer is, customer, you pay me 100 rupees now. When you buy one extra unit next time, at that time we will reduce the price to 80 even for first 10,000 units also. Retrospective reduction of price. This is also called as volume based discount. You buy more volume, take a discount. Today you pay 100, later I will make it 80 for you, even for these goods what you are buying now, depending on the volume you are buying. In this case, observe closely. A customer is standing in front of me, he paid me 100 rupees, he purchased 10,000, in the first month, another 11 months are there. I definitely believe that he will fall into second category. So what is my selling price to him? 80. I believe that he paid me 100, okay, but ultimately I am entitled to keep only 80. So today what I should do is standard will tell you. At 20 extra what you received, no, that is not your money, you may have to give it back to him. Variable consideration. Clear, sir? These are all examples of variable consideration. Now, variable consideration, how to measure? How to measure variable consideration? Look at this, sir. Depending on the time of completion, how early I complete, I am entitled to 10 crores or 6 crores or 4 crores bonus. So, in your transaction price, already 30 crores fixed revenue included. Plus the extra bonus also you can include. But how much? 10 6 4 which one? The standard says you can apply expected value approach. What is the meaning of expected value approach? Multiply with probabilities. Okay, what is the chance of this 10 crore happening? Let us say the chance of 10 crore happening is 20%. The chance of 6 crore happening is 70%. The chance of this is 10%. Go and average them. So 2, 4.2, 0.4. How much is this? 6.6. Is 6.60, add it off. So your overall transaction price is 36.6. If you do this now, this is called as you are applying expected value approach. But the standard also permits you to apply something called as most likely outcome or most likely approach. What is most likely approach? That outcome which is having the highest probability, which is how much? 6 crores. That means your answer can even be 30 crores plus directly 6, which is 36 crores. This is, sir, between these two, which one? Your choice. Between these two, which one? Your choice. That is the decision of the company, sir. That is your policy basically. Am I clear here? Now, there are some questions in study material. Ideally, they should not frame like that, but who will fight with them? In those questions, what happened is, they gave you probabilities like how you are seeing on the screen. When there are more than 2 probabilities, they are using expected value approach. When there are only two outcomes with two probabilities, they are taking most likely approach. That they did for 3 or 4 questions that are there in the study material. Later on, when more questions came, then they express, the question itself tells the entity has a choice of doing both. You will give your answer assuming that they are doing number 1 expected value, number 2 they are doing most likely. So you, just because 2 or 3 questions are presented wrongly, you should not learn wrong treatment. I've seen books where people are writing that if more than 2 probabilities are given, go with expected value approach and all. That is wrong, sir. That's not how you do it. A particular something that is okay. The ICAI did a mistake. That does not mean that you remember wrong things. Some other bigger question you lose marks. So you have a choice. You can exercise any choice. But if the question is silent, then go with that approach. What is that? Only 2 outcomes are given. Go with most likely. Multiple outcomes are given. Go with expected value approach. Clear, sir? So all this I have written here. Next thing. One small point, sir. In the transaction price, if fixed portion lo uncertainty is not there. But this is uncertain only. Variable consideration itself means uncertain. Who dare you to recognize uncertain, whether you don't even know whether you actually receive it or not? Can you directly include like that? This is not any other amount, no, this is top line of the company revenue. Don't you think the standard will be very careful here? The standard says e-measurement, e-estimation, all this is okay, provided you have a reasonable certainty of receiving the variable consideration. But instead of telling this directly, international standard, no, British English, they say that there should be no constraining estimates in relation to variable. If you want to include variable consideration in your transaction price, there should be no constraining estimates. Constraining estimates, and a big English word ka simple meaning is doubt. There should be no doubts about your collection of variable consideration. Uncertainty should not be there. If uncertainty is there, don't include VC in your transaction price. Sir, listen. This particular bonus sum, whatever example you are seeing, no? Customer gave me this chart. Sir, 10, 6, 4, I will give you bonus depending on how quickly you finish the project. Forget about probabilities for a moment. Forget about the probability part. Life low, E type of construction I never did. In the past, I don't have experience in executing this project. So finishing the project on time only is very, very difficult for me. Customer will obviously put a motivation thing that you don't finish off early, I'll give you extra bonus. True. But finishing on time is only doubt for me. I never did this kind of project. Tell me, sir, what is the chance of I earning this bonus? Not there. Should I include or should not include? Should not include. In the past, when I executed one kind of project like this, that project went much, much beyond the due date. Can you include it now? Do you understand, sir? So sometimes the question data itself will be given in such a way that you are not capable of earning that. So you should not include. Imagine, sir, imagine. I know I will not earn that. Despite that, I included it. And I started recognizing revenue over a period of 3 years. Ultimately, fact will be known, no? When? By the end of 3rd year. 3rd year clarity comes. Oh, the variable consideration we are not getting. Then what will happen? Whatever I recognized in 1st year, 2nd year relating to bonus has to be reversed. That naturally will happen. You need not do anything. Degree of completion you apply, automatically reversal will happen. Don't worry about that. Are you getting it, sir? So, now why I am explaining all this is to show you some English. Read here. Constraining estimates of variable consideration. VC is included in transaction price only if it is highly probable that it will not result into a significant revenue reversal when the uncertainty associated with the variable consideration is subsequently resolved. Variable consideration, whether I will get or not, I do not know. There is an uncertainty. When that uncertainty la clarity comes, revenue ka reversal happening ki chance should not be there. Then you can include VC in your transaction. instead of telling directly that include variable consideration when there is no uncertainty, that fellow coded this. And this they will be using in every question. Questions also it is there. So when you see these lines, don't get panicked. He is simply saying that there should be some reasonable assurance that you will receive your variable consideration. There are some examples. If you find any of this in your questions anywhere, believe that our revenue will not come. And therefore you are not supposed to include in your transaction price. Next, in these couple of issues are there that while later on while taking examples and questions I will take up. Next, coming to non-cash consideration. Non-cash consideration means our entity has delivered goods and service. The customer is not paying cash. He is also giving some asset or some other goods or services, something like that. In that case, revenue should be recognized at what value? Apparently you understand, it's like a kind of a barter system. I gave goods and services, in return also I am getting something in kind, goods or services or asset or something I am getting. You have two options only, two possibilities only. What are the two possibilities? Either you should recognize revenue at value of goods and services sold or value of goods and services received. Which one do you think is correct? You must take and recognize revenue based on value of goods and services received. Customer is giving an asset. Asset ka fair value is there. That is the amount at which you should book the revenue. Sir, why not goods given? Look at the definition of transaction price. Transaction price is the amount of consideration to which an entity expects to be entitled. What amount I am going to get, that is revenue. So what am I going to get? I got machinery, sir. Good. For sale of goods and services, you got machinery. The machinery ka fair value should be recognized as revenue. Entry will be machinery account debit to revenue from sale of goods. Are you clear here? Sir, but what I received now, a fair value is not measurable, sir. We do not know the fair value. Then second option, standard says, measure revenue at standalone selling price of goods and services delivered. If these goods and services, normally if you sell to outsiders for cash, how much will you sell? Our price you recognize revenue. That is second priority. Second priority. First priority is always fair value of non-cash consideration received from the customer. If that is not available, then second category. Clear, sir? Imagine. Customer gave you shares in his company for the goods what you delivered. So entry what will you write? Investment in shares of X limited account debit to sales. Correct? The entry will record at what value? Fair value of shares received. Subsequently, a shares ka fair value will dance in the market. No. That does not mean that you will go and change your revenue. Revenue over. Revenue ka story. When investment value updates subsequently, that subject matter of India is 109. Equity investment, either FATPL, FATOCA, make a choice. Fluctuation in that asset is accounted by some other standards. You should not go and disturb the revenue again. If it is investment, 109 is applicable. If that fellow gave you a PP, Ind AS 16 is applicable. If that fellow gave you a license, intangible asset is applicable. If he gave a cow, biological asset is applicable. So other standards will take care of fluctuation in the value of consideration received. Don't disturb revenue what is already recognized. Correct? This is non-cash consideration related point. Next point is significant financing component point. So it's a very, very interesting point. Very interesting point. Very good point. Lot of questions are there. Very easy, sir. Look at this. Very simple point. Sir, delivering goods and services to the customer. Customer giving us consideration are two events. If these two events happen immediately at the same point of time, there will be no interest income, no interest expense, because gap A does not exist. But imagine there is a gap between these two transactions. Gap is there. When gap is there, there is a possibility of financing element creeping into your transaction. Or how, sir? Simple. I sold goods to you. You are paying me money after 2 years. Now I will charge you money only for goods and services. Goods and services plus interest income also. Plus interest income also. Similarly, you paid me full money today only, but I am going to deliver goods only after 2 years. Are you understanding, sir? In this case, even though today you paid me lesser amount, but you are paying me this money even before 2 years of delivery of goods and services. So my revenue is not this lesser amount. This lesser amount plus interest for the next 2 years also will become my revenue whenever I deliver the goods and service. So a time gap, if it is material enough, you have to either recognize interest income or interest expense. In these two possible cases are there. Possibility 1. Goods and services are delivered. Okay, I'll show you the book only directly. Entity delivered goods and services, but amount is to be received later. Tell me, sir, company point of view, interest income or interest expense? Company point of view, interest income or interest expense? Interest income. Why? Goods and services are delivered, customer lo payment lo delay is there. So definitely our entity will charge interest income from the customer. Now, revenue, how to recognize? How much amount you will recognize as revenue? Now, for that, the answer is like this. Your thought process should be like this. First of all, basic internal clarity is there. Sale already happened. Amount did not come. Entry is this. Amount what customer is going to pay me is 100 rupees at 3 years time. Had somebody paid me cash today only, I would have sold at some price. That is called as what? Cash price. Let's say that cash price is 70. Now, we are X Limited. This fellow is a customer. We gave goods on credit to him for a period of 3 years. Had I given, forget about goods, had I given proper loan to this customer, customer should pay me interest, no? Looking at that fellow's face in the sense risk level, I would have charged interest rate of 10% in a standalone financing transaction. If we two people enter into a separate transaction about loan, I would have collected 10% interest from the customer. Are you getting it? Now, I have two questions in front of you. A debtor account debit to sales, should I record with 70 rupees, which is cash price, or present value of 100, which is 100 divided by 1 plus 1.10 whole cube, which is equal to 75.31. Tell me which one is correct. Sir, question only one is given, sir. Then it is very easy. Question of 70 is given, discounting rate not given. So you don't have an option, no, you will take 70 only. Question of cash price not given, only discounting rate is given. Life is easy. 75.31 will be your answer. Both are given, which one will you take? This is your first priority, sir. Because there is sale of goods also, there is a loan also. Actually, two transactions are there. These people merged it off. So, had you done a separate standalone financing transaction with your customer, what interest rate you would have charged? Take that rate, discount your amount. Today, what amount you would have given to the customer? Amount will become your financial asset and sales revenue. This is the first priority. If this is not there, then cash price you will record what is there. First priority is using interest rate in a standalone financing transaction. Am I clear here? Over that. Okay. So this is one case, sir. So if you see the point for this, recognize revenue at transaction price after eliminating the interest income. See whether it is 70 or 75.31. In both of them interest is eliminated, no? But which one? First preference. Interest rate in a standalone financing transaction. If that is not given in the question, then use IRR which equates to the cash price. Sir, what is all this, sir? Simple, sir. So become 70 answer, sir. Debtor you recorded at 70, but debtor will pay you how much? 70, yeah? Debtor will pay you 100. When? After 3 years. Debtor is a financial asset only. On that you have to apply ACM only. For that interest income, every year I have to write an entry called as debtor account debit to interest income. That if I have to record, I need a discounting rate. Which rate will you find out? IRR will know how to work out that. Today 70 should become 100 after 3 years. What is the rate I should use? Future value is equal to present value into 1 plus interest rate whole power 3. A formula only know. That is IRR only know. That rate you will apply as second preference. Clear? Now, this is one case. There is another case. What is another case? Consideration received first. Goods and services delivered later. Goods and services are delivered later. In this case, first observe this. Customer paid you 100 rupees. Happily write bank account. Tell me, can I recognize revenue? Why? Why can't you recognize revenue? Goods and services will be delivered after 3 years. Today, how can you recognize revenue? You cannot recognize revenue. Since you are not recognizing revenue, this will definitely become a liability. Done. Now, what will happen is, for the next 3 years, year 1, year 2, year 3, every year you will pass an entry called as interest expense account debit to liability. With some amount you keep on recognizing interest expense and increasing this liability. In the third year, you actually deliver the goods. At that time, you can recognize your sales revenue by killing your liability. Again, every year to measure this interest expense and increasing the liability, what interest rate should we use? Again, two choices I'll give you. Customer paid you how much? 100 today. The product the house what I promised to the customer is incomplete now. It is not yet complete. 3 years before that only he paid me 100. But I have another building which is complete. There I am selling each unit at 125. So this is for a completed flat today. WIP flat I sold it to the customer today only and customer paid me 100. Delivery will be given not now, after 3 years. My question is, today you received 100 for incomplete flat. Completed flat ka worth price today is 125. Keep 100 today, 125 after 3 years. Work out one IRR kind of rate. Is this correct? Or this time who gave credit to whom? Customer gave money to the company. For my face, if I take borrowing in the outside market, at what rate I can raise money? 12%, sir. Very good. So, every year, interest expense account debit to liability should be record with standalone financing transaction rate or that rate which equates your cash price for a finished product. Which one is correct? Again, same answer. First preference, standalone financing transaction. If me and customer enter into a loan agreement, at what rate he would have lent money to me? Our rate you take. Sir, our rate I don't know, sir. Okay, go to the market. At what rate can you borrow? Bring that rate. You can't say don't know, no. Take that rate. Sir, question of data not there. Last option, you don't have any choice now. Cash price to match, work out IRR into. The discussion is only on the rate. Accounting discussion is accounting is simple. Here what happened? Goods are delivered. First day sales recognized. Amount did not come. Interest income I booked. First money came. Goods I am going to deliver after 3 years. The money what you received is a kind of a loan received. The loan with interest you have to book, no, I am booking. But loan I am not repaying. In place of loan repayment I am giving him goods and services which are the output of my ordinary activities. Therefore I will recognize it as sales revenue. The discussion is only on the interest rate. First priority, standalone financing transaction rate only you should use. That is not there, then go with cash price equating IRR. Clear? On these questions are there. Okay, next. The standard gives you a practical expedient. What is the meaning of practical expedient is just to make the things easier, just to make things more quicker. What our standard says is, if the time gap between delivery of goods and services and consideration receipt, if the gap does not exceed 12 months, time value of money is definitely there. There is no doubt in that. But you can choose to ignore it. My normal credit period 2 months, sir. But to that customer I sold goods with 11 months credit. Definitely I charged interest. There is no doubt on that. But standard says don't bother. Don't recognize interest income. Directly record debtor account debit to sales with full amount. And no, sir, I want to record. I know time value of money properly. Monthly compounding I will do. Do. Your wish. Don't want to do. Then you are exempt there basically. There is a choice. Practical expedient means to make your things quicker. Small convenience adjustments are given. That is that. Next. There are few cases where even though time gap is there, even though financing element is appearing apparently, you still should not recognize any financing component. Time gap significant, but still financing component must not be identified. That means interest income, interest expense recognition should not be done. 3 cases you should not do. Now what are the 3 cases? Number 1, consideration customer paid, sir. Goods and services are also ready, but customer told that I will deliver it to me whenever I ask. Now when will he ask? I do not know. He did not ask for 2 years, but he paid me money on first day. That is, does it mean that he gave loan to me? You understand? Suppose, sir, you took a new SIM card, 500 rupees you paid for top up, 500 balance you have. You can use it any time in the next 2 years. From Airtel point of view, you think you paid money to Airtel on first day. That fellow told use it any time in the next 2 years. What you did, you switched off the phone and did not use it at all. You used it directly after 1.5 years. And now you are saying that, I paid money 1.5 years back. Now only I am demanding services. Will Airtel give you now? Yes, they will give you. But does it mean that you gave loan to Airtel? You gave 500 rupees loan to Airtel? No. But there is a time gap which is more than 12 months. Why is it happening? It's happening because goods and services are delivered to the customer at his discretion. In case of gap will be there, gap may be there, but that does not mean that I am taking loan from the customer. So that is one case. Case 2. The consideration is highly variable. The consideration is highly variable. It is highly variable. You cannot identify the financing component there. Imagine one old fellow wrote a book, a song of ice and fire. That fellow is almost dead many times. Okay, a book is sold million copies already. Worldwide blockbuster. TV series is also made. For 10 years, people spoiled because of that. Okay. Now, after writing the book, he will give it to a publisher. A publishing company will print books and sell. And every book sold, my revenue is 250 rupees. Now, when will I get revenue? Every year. Every book sold I get. Like that for how many years? Lifelong. Whose lifelong? Not my lifelong. Book lifelong. As long as books are getting sold, me or whoever I represent, they keep on getting money. I am already billionaire. My next generations also will become billionaire on their own because of that royalty, not because of my inheritance. So I wrote book 100 years back. My great grandchildren are eating money today also. I delivered the manuscript to the publisher 100 years back. Money he is giving me today. Gap is there or not there? There is no financing element in this. You can't identify that. Third case. The gap is there, but gap is there because of other reasons, like security deposits and all. Small example. I am a customer, or let's say I am the builder. I agreed to construct a building for a customer. I told that customer, as 20% work gets over, you also release me money. Customer said, okay sir, depending on work done, I keep on giving you progress payments. 20% work is done. Customer, this builder goes to the customer and asks, sir, out of 10 crores, please give me 2 crores, 20% work is over now. Wait, customer will say, bring one independent party. He is saying that 20% work is over. Is it really over or not? Certify the work. Work certified, 20% done. Then I will tell the contractor that you are eligible for 20 crores, but I will pay you only 18 crores. Another 10% I will withheld. I will pay you this also when last low I will pay. This is called as retention money. Why am I holding back that 10% in every payment? I owe him 20, but I'm paying 18. 2 I'm holding back. Why? Because I want money. Because I'm taking loan from him. No. Why am I holding it? What I am worried is, if I pay full money like that, if that fellow runs away, who will do the remaining job? Or there are so many people who don't pay money for your services immediately. They are worried that if they pay you completely, you will run away. So they will make you do one more work and then they will pay you consideration related to the previous work. So it's like, if you want to leave the organization, you kind of be prepared to forego one big payment. So security reasons keep people withheld money. That does not mean that they are taking loan from you. This kind of thing. Another beautiful example is in study material. That is, I sold a laptop. Tell fellow sold a laptop. A laptop international warranty is there for next 3 years. Any time, any country, this laptop gets spoiled, we'll come and repair it. We'll come and repair it free. But if you want this protection, customer has to pay 3,000 rupees on day one. First, at the time of sale only, you pay 3,000. I will protect you anywhere in this earth for the next 3 years. You paid. So when am I going to give my service? For the next 3 years, any time. Time gap will be there or not? Time gap, every chance at 12 months it will exceed or not? But that does not mean that there is a significant financing component there. Why is it not there? Why did I collect in advance? Why I collect in advance is, monthly if I ask, customers initially they will pay, later on they will not pay. You buy a new mobile, what will you do? You will hold it very carefully. First week. After 1 week, you will throw on bed. Correct, no sir? As the time progresses, you get confidence and nothing will happen. Another feeling will come. After 1 month, you will be driving bike and parallelly watching. So, as you progress, no sir, your confidence increases and the utility value does not decrease, but you start becoming more careless. You will get more confidence on and nothing will happen even if it falls on water. That kind of feeling will come. Just why to pay unnecessarily monthly 10 rupees, 100 rupees will not pay. This is one kind of problem. Another problem is, some buggers will pay monthly 100 rupees. After paying 6-7 months, nothing is happening to this laptop. Let us do something. Let us recover our 600. They will do something. This kind of mischief is there. And bugger, if does not pay 7th payment, I have to maintain a team and make him call. Sir, your subscription is over. Kindly, would you like to extend it by 1 more month? Who will do all this job? I directly collect 3,000 advance. You pay, take, otherwise get lost. For that I took, not that I want loan from a customer. Dell company wants loan, sir. Last case in transaction price is consideration payable to a customer. Normally, when we sell goods to a customer should pay consideration to us, correct? But in some cases, what they manipulate is, I sell goods to a customer, goods worth 10 crores. I charge 15 crores. Why will customer pay, sir? Tell you. Customer will tell that, you pay me 15 crores, in some other transaction, I will return 5 crores to you. In this, effectively if you observe, first I sold goods, I received 15. In some other transaction, I paid off 5. Effectively, I received 10 only. Therefore, customer also may be willing to do this game. In this, what is the advantage I am getting is, I am artificially boosting up my revenue. Sales figure itself is a very important indicator. No, a sales figure I will manipulate. So, on one side I am selling goods, I am receiving consideration, and at the same time I am also paying consideration to the customer. Whenever you are paying consideration to the customer, the standard asks, are you receiving any distinct goods and services from the customer? No sir, we did not receive anything. Congrats, whatever you paid to him should be reduced from whatever you received. I received 15, I paid 5. For this 5 what I paid, I did not receive any distinct goods and services. If 5 should be adjusted to that 15. Effectively, revenue should be recognized only at 10 crores. This is the provision given. No sir, I received some goods and services. Then the standard will ask you, what is the fair value of the goods and services? 3 crores sir. How much did you pay? 5. Did I pay excess? To that extent, you would have manipulated the sales price. It too, go and remove it from 15. Effectively, your transaction price should be 30. This is the last concept of transaction. Out of our 5 steps, we are done with 3. Next one is how to allocate the transaction price to the POs, and finally when to recognize revenue. So now that our step number 3 transaction price is over, we have to go to step 4. Before we jump into step 4, on step 3, ICAI study mat has at least got some 15 to 20 questions on this step 3 transaction price. In that 4 issues are there. One is variable consideration, and then we have significant financing component, non-cash consideration, and cash paid to or consideration paid to customer. 4 cases. Now coming to allocating the transaction price to performance obligation. When there are multiple POs in a single contract, then your transaction price you have to identify it to each PO. You have to allocate the PO, transaction price to individual POs. Now how to allocate that? Now let us say I promise to deliver 3 goods A, B and C for a combined price of 120. Whatever standard says is, if 120, whatever transaction price is there, the transaction price should be allocated to all the POs in the ratio of standalone selling price. Identify something called a standalone selling price, and standalone selling price ratio lo A, B, C ki 120 rupees you allocate. What is SASP detail we will see in a while. So imagine this is 75, this is 45, this is 25. No, 75, 50 I will take, and 25. So this is 150. Standalone selling price ka meaning is observable selling prices. That means if you sell A alone to a customer, at what rate will you sell? B alone, at what rate will you sell? That is called as observable selling prices. Observable selling prices only you will call it as SASP, and that SASP ratio lo, a transaction price should be allocated. When a customer buys A, B, C independently, overall you are charging him 150. But if a customer takes, but to a particular customer, you gave A plus B plus C together at 120 only. Okay, that means you gave a discount of how much? 30. Whatever standard says is the transaction price should be allocated in the ratio of SASP. If you allocate now, what is the answers you are getting? 60, 40, 20. This is which ratio? 75 is to 50 is to 25. That is 3 is to 2 is to 1 are ratio allocated. By doing this, whatever discount is there, 30 rupees. Indirectly, can I say discount also got allocated in the ratio of standalone selling price? Right. So 30 also actually got allocated as 15, 10 and 5. So allocating discount on the ratio in the ratio of standalone selling price is as good as you allocating transaction price in the ratio of standalone selling price. So whenever you allocate TP in SASP ratio, automatically, knowingly, unknowingly, you are also allocating discount also in the same ratio. First observation. This is a question, sir. Question number 2. A, B, C. You are selling at some price. SASP is 75, 50, 25. Now, this B and C, ideally, if a customer buys only B plus C, you should charge him how much? 75. But what you are doing is, B plus C, if somebody is buying, you are selling that at 50 rupees only. And to the customer, you are charging 125. So, you are offering a discount of 25 to the customer who is buying A also, B also, C also. But if there is some other customer who does not want A, he buys only B and C, ideally you should charge 50, but to that fellow also you are charging, ideally you should charge 50 plus 25, 75, but you are charging only 50. That means you are offering how much discount to that customer? So 25 discount is offered on B and C put together. Whereas if a customer is buying A plus B plus C also, you are offering the same discount. That means, can I confidently say that E discount relates exclusively to B and C alone and not to A at all? So when you are allocating, care must be taken that discount nothing gets allocated to A. So how you will do this is, A ki happily write standalone selling price. Out of 125, 75 is for A. Remaining 50, whatever you are collecting from the customer, that you will allocate it to B and C in the ratio of 50:25. That is 2:1 ratio. You will allocate it. So that will work out to 33.33 and 16.67. Are you understanding, sir? This is which point? This is a point where it can be proved that the discount given in the contract exclusively relates to a particular PO or a bundle of particular PO. Discount also must be allocated only to such POs and not to all the POs in the contract. If nothing is mentioned, you will do like this. If there is a proof in the question that a small bundle of goods is sold for a discount, then you must ensure that our discount goes only to that bundle of goods and not to all the goods in your contract. So that is one thing you should be careful. Next, sir, you conveniently took like this because ordinarily B plus C you are offering at a discount of 25. If somebody is buying A plus B plus C, then also you offer 25 only. What if you are offering not at 125? Here I am reading another case on this side. Let's say I am offering 120. So I am giving them a discount of not 25 now, 30. Then what will you do? E type of question till date never came. Never came. But you can guess. 30 discount terms. So how should I do it? So total discount I am giving 30. If somebody buys only B plus C, anyway would have given discount of 25. So extra 5 rupees discount is given on what? On all three. On all three. So first what you should do is, first to do this. E part common. First you do. But actually you are selling not for 125. You are selling only for 120. Another 5 rupees discount is there. 5 rupees you should now remove it from A, B, C in the ratio of 75:33.33:16.6. The ratio lo -5 if you allocate, then a 125 transaction price will now come to 120. A extra 5 rupees should not be identified towards A. That should be identified to all the POs. You clear here? This type of model did not come till now. This is whatever you are seeing on the screen now, that came. A extra 5 rupees discount wala case did not come till now. Next, coming to the theory part of this standard. E-step rules are, what they say is transaction price should be allocated in the ratio of standalone selling price. Standalone selling price, how to work out? That is what is there to work out? It is nothing but observable selling price, the price at which you individually sell them. Sir, but individually don't sell them, sir, then what to do? If you don't sell them individually, then you have to estimate standalone selling price. Sir, how to estimate? A standard gives you 3 methods. First one is AMA, Adjusted Market Assessment Approach. Adjusted Market Assessment Approach means you are not selling a particular product individually, but market lo somebody will be selling, no, go and take that price. But you can use the same price if that product and our product are literally same. If they are not same, either our quality is poor or our quality is better. So accordingly you modify the price. So I take the price from the market, adjust it. Therefore we call it as Adjusted Market Assessment Approach. Look, a method in which you work out the estimated standalone selling price of a particular good or service. This is one method. Second method that is permitted is EC plus M. Estimated cost plus margin. If I have to deliver a good or service to a customer, how much cost am I incurring in fulfilling that obligation? Whatever goods I have to sell, what is the cost of manufacturing the goods? Plus reasonable margin what I want. That you add, that you understand it as standalone selling price. This is the second method that is permitted. Third method is called as residual method. Honestly speaking, a residual method is not a method. This is a balancing figure. Residual method is not a method. This is a kind of a balancing figure approach. How to do directly with numbers I will show you. Watch. In these two issues are there. If you are not careful, you will mess up the entire thing. There are 3 POs in a contract, sir. SASP of A is available. SASP of B I know. CK I do not know. I have 3 methods which I can apply. Time being, first method, second method I don't want to apply. I want to do balancing figure approach, residual method approach. Residual method how to do is, suppose the transaction price is 135. What you will do is 75 as it is you will write. 50 as it is you will write. 75 plus 50 is how much? 125. But our transaction price is 135. So extra I am collecting how much? 10 rupees. 10 rupees is identified as revenue allocation for POC. That's it. This is called as residual method. But if you have to work out a allocated price based on this method, there are two important points you have to keep in mind. Number one, if at all A plus B put together are independently sold at any discount, our discount must be first allocated to A and B. Let me write again. Same example, I'll again rewrite. A, B, C. I am selling for 135. SASP is 75, 50, don't know. If somebody buys only A plus B, ideally I should charge 125, but I am charging only 100. That means for a person who buys A plus B only, I am anyway offering a discount of 25. So if you want to apply a residual approach for identifying the value of C, you must ensure that E 25 rupees discount is adjusted to A and B. So A and B put together you should record 100. Of course, we will allocate in the ratio 75 is to 50, but 100 rupees you have to allocate like that. Then you take the balancing figure as 35. This is correct. Instead of doing this, if you directly copy 75 and 50, what will happen? The balancing figure will be, you know what you did? The discount given on A plus B, you went and reduced from goods C. That will happen. Are you understanding, sir? If you want to apply residual approach for a particular PO, ensure that other POs ka discount, if any, is there, that must be adjusted to the other POs only first. Without adjusting that, you should not take a balancing figure. Clear, sir? So, this particular answer is normal case. This is correct. But if A plus B are sold at a combined package at a discount, our discount first allocated. After allocating the discount only, take a balancing figure. This is first point you have to remember. Second point is, whatever balancing figure answer that comes to, residual method ka answer, that should fall within the range at which the product is sold. I mean to say, suppose sir, I am selling shoes. Shoes where I am selling? Roadside market I am selling. Pakka looks like original, Nike sticker, everything is there. You come and ask me, I will quote 3000 rupees. Depending on what is my assessment of. I'll quote 3000. But ultimately I don't mind selling it for 1200 also. You start bargaining from 300, 3000 now. 250 I will give and start. Ultimately I will sell it around 1200. Start Sunday morning. Sunday night I am packing everything and going home. One customer came. Sir, issue price. I told 3000. That fellow says 150. Now, I don't have any mood to argue. Moreover, I want to sell off. I told, don't do overaction. 500, deal close. Okay, take 500 done. That means, understand. My maximum is 3000. Minimum is 500. Below that, I will never go. At what rate I will sell, I do not know now. But I know the range. 500 minimum, maximum 3000. So like that, when you get a balancing figure, a balancing figure number should be falling within the range at which you will sell the product. A range, if it is fitting only, a method is appropriate and acceptable. Suppose you got 35 balancing figure, put your hand on your heart. Will I sell C for 35 anytime? Is it possible? Possible. Correct. No sir, C ka range is 50 to 75. But balancing figure, how much did you get? Residual method cannot be accepted. Sir, then how will I get SASP? There are two other methods, now apply them. AMA, adjusted market assessment, or expected cost or estimated cost plus margin approach. Apply those two methods and bring the SASP. Residual method you cannot apply. Residual method ke two conditions are there. Go see here. Residual method. This method to be applied to complete SASP of PO only after allocating discount to other POs, and the result of this method is accepted only if it falls within the range of selling prices at which goods and services are set. Am I clear here? This is about SASP, not available estimations. If SASP is available, then SAP is very easy. Read the previous point also. Any discount offered to the customer shall be allocated to all the POs in the ratio of SASP. The general rule. Exception. What is the exception? If discount offered is exclusively relating to a specific PO or a bundle of POs in the contract, then discount is allocated only to such a PO or such a bundle of POs, but not to all the POs. But this is a very, very famous question. It came for 10 marks twice in the exam. The residual method, allocation and all. Easy only this much. In this, one issue is there. On this issue also, one fantastic, very big question is there that you will practice later on, but I'll tell you the gist of that. Imagine, ma'am, I have two POs in my contract, AB. My transaction price consists of fixed consideration and variable consideration also. Fixed consideration is 50, variable consideration is 10. So overall transaction price is 60. General rule, what does it say? Transaction price should be allocated to POs in the ratio of standalone selling price. When you tell me that, indirectly, are you not telling me that fixed also should be allocated to A and B, variable also should be allocated to A and B? Because a transaction price should be allocated means fixed consideration also should be allocated, variable consideration also should be allocated. Ideally, this is what you are supposed to do based on the language of the standard. But what our standard also says is, if variable consideration is exclusively relatable only to a specific PO, then ensure that variable consideration is allocated only to such PO and not to all POs. Just like a discount case. If discount relates to only a small PO or a small bundle of POs, ensure the discount gets allocated only to that POs. Like that. For example, I have been given the contract to construct a road. The construction of road is one PO. And then I have to do maintenance of this road for the next 15 years. For this, consideration is 500 crores. Plus, if construction is complete within 3 years, then I will get additional bonus of 100 crores. Tell me, sir, 100 crores variable consideration is relatable to which PO? When will I get that bonus 100 crores? Construction should complete within 3 years. Tell me, sir, is it appropriate I allocate any portion of that 100 crores to maintenance? No. Are you understanding, sir? When variable consideration exclusively relates to a particular PO or specific bundle of POs, no, ensure that variable consideration is getting allocated only to such PO but not to all the POs. This is general rule. This is specific rule. Clear? Now, there are some people who are capable of using these provisions for manipulation. How manipulation? Look at this. AB. A ka work will get over in 1 year. B ka work will get over in 3 years. A, low value item. B, high value item. They will manipulate the prices in such a way that more revenue gets recognized in the initial year after allocation. What they will do? Variable consideration part, the high value item is there. In the contract I'm telling, in the contract, they will put this low. So the remaining portion of B consideration, whatever is there, that they will put it as variable consideration in A. What will happen because of that? You will also go and allocate this variable consideration completely to A only, because in the contract what did we write? Variable consideration is linked to performance of A. And A is getting performed and completed within a span of 1 year. Therefore, entire revenue gets recognized in the first year only, even though B is still incomplete. So this kind of manipulations ki chance is there. So this standard puts one final checkpoint now. What this says is, read the objective of this step. Transaction price is to be allocated in a manner which fairly depicts the consideration entity expects to receive from the transfer of goods and services. Individually, if I transfer, how much money will I get? That much only should be represented against each PO when you allocate them. If the number is looking slightly odd and all, then you have to change the allocation pattern. Look at this example. I'll give you a proper example. It's a question in study material. It's a very, very fantastic question. There is license A, license B. In license A, the standalone selling price is 20 lakhs. License B, the standalone selling price is 16 lakhs. Total, it is 36 lakhs. It is standalone selling price, the real worth of each goods. Okay. In the contract, how that fellow has written the contract is, for transferring license A, the customer will pay 20 lakhs only. But for transferring license B, the customer will pay 3% of his sales as royalty. I'll give him license. With that license, he will manufacture goods and sell. On that sales, 3% he will pay. And the question tells you that the worth of this 3% estimated on starting date is equal to 16 lakhs. Estimated. First date's worth is 16 lakhs. Now tell me one thing. Is the price what you recorded in the contract, is it representing standalone selling price or not? For A, how much did you write in the contract? 20 lakhs. What is SASP of A? 20 lakhs. Similarly, for B, you are receiving variable consideration. But variable consideration ka worth also is how much? 16, which is also matching with the standalone selling price. Is there any problem now? There is no problem. Since there is no problem, you will understand that in your overall contract, fixed consideration whenever you receive, that is revenue of A. Variable consideration whenever you receive, that is revenue of B. So you will not apply your general principle. What is the general principle? Entire transaction price should be allocated to all the POs in the ratio of SASP. If I do that, what will happen? 20 lakhs also should be allocated to A and B. 16 lakhs also should be allocated to A and B. That I will not do now. Why? Because whatever contract prices you people have written in your contract, they are matching with the standalone selling price. In this, there is no manipulation and all. So I will ensure that variable consideration exclusively goes only to B, fixed consideration exclusively goes only to A. Are you understanding this? It is a plain case. Now I will show you manipulated case. 20 lakhs, 16 lakhs for A, B, these are SASPs. In the contract, how this fellow wrote is, he will receive fixed consideration of, I don't remember the numbers actually, but anyway, 6 lakhs here. And here, instead of 3%, he will receive some 8% of sales as royalty. And the worth of this 8% as on today comes to 3 lakhs. Overall from the customer, how much am I going to collect? 36 lakhs. But in the contract, fixed consideration is recorded against which PO? A. Variable is recorded against B. Overall the number is matching only. But the individual numbers what you wrote in your contract, are they matching with the standalone selling prices? No, they are not matching. Since they are not matching, you will now go and do your original allocation. What is your original allocation? Fixed consideration also you will allocate it to A and B. Variable consideration also you will go and allocate it to A and B. Contract law you might have written that variable consideration exclusively belongs to B and you might have written, I don't care what you write in your contract. Because I have to fulfill the objective of step number 4. Step number 4 ka objective is what? After you allocate the transaction price to each PO, the number should fairly depict the rate at which I sell each PO. If it is not depicting, no, I can't give you exception that variable consideration belongs to B only and all. Then I have to allocate fixed also to A and B, variable also to A and B. On this one, fantastic question is there. The question fact numbers are almost same. Go through that question. It's a very interesting question. So guys, that is about your step number 4. Now coming to finally step number 5. It's a very easy step, sir. Look at this. Step number 5 says recognition of revenue is directly linked to the timing at which control of goods and services are transferred. If goods and service ka control is transferred over a period of time, revenue also should be recognized over a period of time. No sir, it is transferred at once at a particular point. Good. Since control is transferred at a point in time, revenue recognition also will happen at a point in time. Okay. Now, sir, when will I identify it as control transferred over a period of time? When will I identify it as control transferred at a point in time? That we will discuss in a while. But before we do that, understand this. Whenever you say that control is transferred at a point in time, revenue also is recognized at once. There will be a single entry of recognition of revenue. Remember, I gave you one example earlier. A customer paid me money today only, but flat I will deliver to him after 3 years. Money when did I receive? Now, after constructing a flat, I will deliver the flat to the customer after 3 years. So control over the flat is given to the customer after 3 years. So revenue recognition, when will it happen? After 3 years. At a point in time, I might have received money today only, but goods ka transfer, control is happening after 3 years. Revenue recognition also happening after 3 years. Are you understanding, sir? Now, is it construction only? Is it building only? Even though this is construction of property, even though this is construction activity only, I am not applying degree of completion method. Correct? You paid me money for flats, sir. Flat is under construction. Entire money received off. I told you that a building I will give it to you after 3 years. Flat I will sell it to you after 3 years. Control is getting transferred after 3 years. Revenue also will be recognized after 3 years. Where is degree of completion? So you should never think that if it is construction business, we should apply degree of completion or to come out of that. That's why it is removed. Earlier we used to have a separate standard on construction services. It's under Ind AS only. I'm not talking about AS7. Ind AS only, another Ind AS was there, 11. They removed it. Ind AS 11 was construction contracts. They removed it. Why they removed it is wrong. Revenue recognition should be linked to control. Just because it is construction, always you should not go and apply degree of completion. Am I clear here? Another example. Customer has a land, vacant land, customer is having. Customer called me, I am a builder. Sir, kindly construct a house and give it to me. I told, okay sir, I will construct a posh bungalow for you, but it will take 2 years time. He said, okay. I started constructing. Every brick I put, every work I do on that. As I construct, is the work going into the hands of the customer? Is the work going into the control of the customer or not? Yes. Why? Land belongs to him. Earlier example what I gave, land belongs to me. I am constructing apartments there. Just because he paid money, from tomorrow if he comes and directs me how to do my work, will I listen? No. But here, whatever customer asks, I will do. Land is his. Tomorrow if I stop the work and go also, whatever I already did, that will be useful for the customer anyway. That means what, sir? As I do the activity, the goods are going into the control of the customer over a period of 2 years. Since control is passed to the customer over a period of 2 years, revenue also should be recognized over a period of 2 years. Since I have to recognize revenue over a period of 2 years, I need to apply degree of completion method to identify the progress of the work. Whatever we understand it as degree of completion in C enter, Ind AS 115 calls it as measure of progress. Instead degree of completion, but they call it as measure of progress. So how to measure the progress? There are two methods given. One is input method, one is output method. Input method means we will identify the degree of completion based on how much efforts and inputs you have kept in. Classic example of input method is your cost incurred till date divided by cost incurred till date plus estimated future costs into 100 and whatever formula we apply, no, that is an input method, because you are identifying the degree of completion based on how much cost you have spent. Like that number of hours spent also you can see. For finishing a project, I have to spend 200 hours. For finishing FR class, I have to take 250 hours. By my balance sheet date, I already finished 100 hours of the class. 100 by 250. 40% work is over. Are you understanding, sir? Input base means how much we are giving into the contract for fulfilling the PO. Based on that, if you measure the progress, it is called as input method. On the other hand, output method means, for example, I have to construct a road of 200 kilometers. In the current year, by the balance sheet date, I already finished 40 kilometers. 200 kilometers, 40 kilometers is over. 20% work is over. Correct? No? Quantity basis you are seeing. Or you hire a external expert. He will come and give a certificate to you. Survey done by an external expert. This is also called as a output method. Cost based method, if you apply, that is called as input method. Okay, now why the story about this input method, output method is important is there are few questions where if you do not understand the implications, you will suffer. Correctly observe this. A small example I'll explain. Suppose, sir, year 1 I am talking. Cost incurred in current year is 500 or let's say 200. Estimated further costs is 300. So a project, if I have to finish, I have to incur a total cost of 500. I am talking about a case where revenue is recognized over a period of time. Okay, so I need to measure of progress, or you can also call it as degree of completion. Let us say I am applying cost based approach. So 200 cost incurred till date divided by total cost on the project into 100. How much work is done? 40%. Now, if I tell you that transaction price is 700 rupees. So, according to the standard, what will happen is revenue for year 1 is equal to 700 into 40%, which is how much? 280. Now, general common sense. Out of the total revenue, if I recognize 40% as revenue in the current year, out of the total transaction price, 40% is recognized as revenue in the current year. Should I not record out of the total cost 40% as cost in the current year? Otherwise matching will not happen, no sir. Are you understanding? What is the total cost? Project cost 500. What is the degree of completion? 500 into 40%. At 200 you need not separately recognize. At 200 naturally will be in your P&L account only because that's expenditure incurred in the current year. Are you understanding what I am trying to say? So when you apply cost based approach, what will happen is, sir, in your P&L account, whatever cost you are recognizing, okay, which is 200, this is already representing what? 40% of the work done. In fact, a stupid 40% itself is computed based on this 200. Why will it not match? It will match. Now sales revenue you are recognizing an amount of 280. This is also based on 40%. Profit 80 balancing the P&L will come. Are you clear with this? This is one easy way. Okay, is input method. Now I will tell you another case. Data same, total data same. This time, you hired an expert externally, that fellow gave a certificate. He told you that measure of progress is 30%. He says that only 30% work is over. Since only 30% work is over, what should I do? Revenue recognized is equal to 700 into 30%, which is equal to 210. Now you see what kind of problem you will face. Sale will be 210, but cost what I incurred in the current year, that I cannot change, no. 200 I incurred. I cannot change that. 200 I incurred and debited it to P&L account. But if you observe, revenue 30%, transaction is 30% you booked as revenue, but total cost of 40% you booked as cost. It is wrong. Whatever profit you are getting, that is wrong profit. That's not matching concept went for a toss, no. Correct? What you should do? That means what, sir? I incurred certain cost but that cost does not qualify to get recognized as revenue in the current year. But you get recognized when? Next year. So this extra amount, whatever you recognized, it should be identified as a contract asset, indirectly inventory. Imagine, sir, I produce 1000 units in the current year. 800 I could sell. At 200, where will it be? Closing stock only, no. That only you have to recognize. E problem will come when you apply output method. Input method la problem will not come because revenue and cost both will be standing at the same percentage level. Output method it will not happen like that. Our questions will not tell you that it is output method, and clearly they won't tell you. Silently somewhere they will include based on a survey measure of progress is 30%. But if you start doing, one should be very, very careful. Contract asset or contract liability chance is there. Here expenditure spent is more, but revenue recognized proportion is less. So the money what you spent does not qualify for recognizing revenue yet. It's like an inventory now. So what you should do now? You should recognize a contract asset to P&L account. With what amount? What is the total cost? 500. How much work is certified now? 30%. So I should recognize expenditure of only 150. But actually I recognized how much? 200. Extra recognized 50. If 50 rupees, whatever is their gap, with that 50, write this. Contract asset. Now perfect matching will happen, correct profit. Are you understanding, sir? Is it logical enough? So how will you identify in the question? When somebody use survey report, output method and all, e problem you have to check. Cost basis the problem will not come. Am I clear, sir? Right. Now, e point and all I have written here. Output method, cost incurred but not recognized as an expense to be shown as a contract asset in the balance sheet. With output method, this has to be done. Now coming to input method, there is one more case, sir. This conceptually actually slightly flaw. You see deeply there is a flaw. But the question is a stock question for ICAI. Almost 2-3 times they ask it till date and it will not come for anything less than 6 to 8 marks. So just for the sake of proving something, you should not try to be different. Okay, whatever ICAI expects, do that. What is the case, I'll tell you. I don't know why they love this question so much. These are, I am a builder. A customer gave his building, gave his land for construction of building. The construction of building is expected to take 2 years' time. After finishing the building, I have to install air conditioners, lift and all in that. When, sir? Sir, if khali empty land is there, will I buy AC today? Will I buy lift today? No. When will I buy? After entire construction, so last thing I will do is that what this builder did is he purchased lift today only. Elevators he purchased today only 15 lakhs. After buying, he is putting it in the construction land, covering with a cover he put outside, it is there. But cost incurred. Cost incurred. And other expenses also incurred. 5 lakhs. This is proper construction cost. So this fellow claims that I totally incurred a cost of 20 lakhs. Estimated total cost is 45 lakhs. So this fellow idea is out of total 45 lakhs, I already incurred 20 lakhs. So almost some half of the work is done. So let me recognize revenue to the extent of half of the thing. I am telling you transaction price also. If I remember correctly, transaction price is something around 50 lakhs. Right, something what is it, 60 lakhs. Not a test of memory, no, so why to worry. Okay, fine. What our standard says is, when you apply measure of progress under input method based on cost, consider only those costs which are helping you in satisfying the progress of PO. Elevator sir, lift you purchased. Because you purchased lift, the progress of construction will increase. Unwanted expenditure you incur, that does not mean that the building is getting constructed faster. So what the standard says is, when you write cost incurred till date divided by total cost into 100 formula, do not consider the cost of that item which is not contributing to the progress of the PO. Ignore that. Numerator or denominator, both sides ignore, and then measure the degree of completion. The cost incurred 20 lakhs or 15 lakhs, ignore. No, remaining is how much? 5 lakhs. Denominator, total 45 or 15 you remove. Remaining is how much? 30 or? Total, no? 30 lakhs into 100. Do the maths, sir. How much are you getting? 16.67%. You will apply 16.67% and recognize the revenue. Up to here, thought process is perfect. Thereafter, what our study mat says is, in your P&L account, you incurred expense that nobody can deny, 15 lakhs, 5 lakhs. Overall, you incurred 20 lakhs. Now we have to recognize sales revenue or revenue for construction, whatever name you describe it. Total sale promised to you is how much? 60 lakhs. What this fellow says is, out of 60 lakhs, you will get some consideration for elevator also, no? Remove that. On the remainder only, apply 16.67%. Please do the math. 45 lakhs into 16.67. Some number, okay, that, hold it, I need that. Plus, since 15 lakhs you booked it as expenditure already, recognize revenue to the extent of cost of elevator. So this 7,50,000 what is coming here and this 15 lakhs total put together, how much are you having, sir? 20? 50? This is what? Or ICAI questions are there. What they are asking you to do is, 15 lakhs you incurred, it is there as an expenditure on the debit side of P&L account, but it is not contributing to the progress of the work. So degree of completion measurement, remove it. Similarly, while measuring the revenue, recognize the revenue on this 15 lakhs only to the extent of cost incurred. That is what is happening. Their ideology is, I am stopping you from recognizing the profit on elevator. For buying and installing elevator, some profit margin you will have, no, that profit I will stop you from recognizing. That is the idea behind this treatment, I say answer. But if you closely observe, a profit is getting recognized. Our 60 lakhs is a total sales price. What are you removing? Cost you are removing. Are you understand, sir? So a profit what you wanted to charge on that elevator, that stupid thing is there in that brackets only still. Cost only removed. A 15 lakhs ka profit whatever is, it's still inside that brackets only, and on that 16.67% you are recognizing. So that is slightly flawed. In fact, ideally what could have been a much better answer is, this one, don't recognize it as revenue. It's only 7,50,000. If 15 lakh rupees, you will show it as a contract asset. Just like previous we discussed now, inventory, which what is there? Then also answer will not change. Profit will change will not come, no. But that's what they did. And they have a supporting argument that I already gave control of the elevator to the customer. So that is a counter argument there. But overall there is a small flaw, but you have to remember this. Since anyway you have to remember this, I wrote here. If significant costs are incurred without contributing to the progress, ignore such cost in calculation of measure of progress. Recognize revenue to the extent of cost incurred. Right, so this is about input method and output method. Next. Last aspect of step number 5 is, sir, how will I know whether PO is satisfied over a period of time or at a point in time? Now, how will I make the judgment? Pretty simple, sir. The standard gave you 3 criteria. You fall under any one of these 3. It is to be understood as PO is satisfied over a period of time, because control over goods or services also transferred to the customer over a period of time. If you pass any one of the following 3 criteria, you pass more than one, no problem. One at least you pass, PO is treated as satisfied over a period of time. Sir, what if I don't fulfill any one of these 3? Then automatically you are treated as PO satisfied at a point in time. As simple as that. Okay. Now, what are these three criteria? First one, our entity performs the delivery of good or service, and as they perform, the customer simultaneously, immediately is receiving benefit out of that. Like our class, I am delivering. You will get benefit after this, after 1.5 years. No. Immediately you are understanding. So it's like as I deliver, the customer is immediately getting benefit out of this. Okay, next. I have a old bungalow, booth bungalow, owner. I appointed somebody for doing the cleaning job. Nobody is coming forward. One fellow has a lot of guts, he accepted. He says that I will clean this entire bungalow, but it will take 3 months time. But after 3 months, it looked like a new building. Fine. They started doing work. 10 people daily, they are working. After each day of work, as they clean, is the customer getting benefit out of that or not? Consuming means not eating, deriving benefit. Are you understanding that? Right. This standard, they went one step extra and they told like this. How to know whether customer is getting benefit out of this simultaneously or not? What they ask is, hypothetically assume that customer terminated your contract and appointed someone to do the work in place of you. That new someone who is going to come, is he going to start the work from the very beginning or from hereafter? If he is going to do the work hereafter, that means whatever work you have done has already given benefit to the customer. Are you getting it, sir? Suppose you stop the class and run away. The management of this institute hired some other FR faculty to finish the remaining topics. He will not start from Ind AS 1, no. He will only do business combination remaining standards, because the work whatever I have already done has given benefit. That's how you have to check. I have to travel from here to Sri Lanka, or let's say I want to travel to Russia. I have to shift 2 flights. I purchase ticket, one carrier. Of late some problem has come. It stopped somewhere in Dubai. They said, don't worry sir, we are arranging another flight. What will that another flight do? They will bring back to Bombay again. Huh? No, remaining work only. So like that you have to understand. Either this or, second example I already gave you. Entity's performance creates or enhances an asset that is in the control of the customer. Customer land belongs to the customer. He appointed me to construct a building. As I do the work, a building is naturally going into the control of the customer. Control is passed. Are you getting it? Third one. As I do the work, an asset is getting created. An asset is having no use for us other than giving it to the customer. As I do the work, some kind of material is getting developed, some kind of information, some kind of asset is getting generated. That asset I don't have any use other than giving it to the customer. In that case, the standard says treat it as PO satisfied over a period of time. The last one is easy only thing is it's not straightforward. Example. You appointed me to do due diligence work. Due diligence is a kind of confidential assignment like audit. So, I am doing the work. You want to take over some company, sir. Before you finalize the deal, I am sent there to see the financials, what are the decisions they made in the past, whether they are good propriety or not and all. 6 months work, 3 months over. In 3 months of whatever work I did, no, the work will not go into your control. Why? Entire working papers are property of auditor. Work is in my hand. And as I do the work, you are not getting any benefit. You will get benefit only when I finally submit the report to you. First point, second point, not satisfied. But I am doing work 3 months. Another 3 months work also I will do. But after doing all that, ultimately report comes. What will I do with that report? I will read and feel good myself. Huh? No. Tissue paper? Huh? Paper rocket? Huh? No. Each particular report, I have to give it to the customer. I don't have any other alternative use. Or you can do insider trading, sir. Legal consequences will be there, sir. No alternative use means legally not permissible or in the contract not permissible. Clearly he will tell, are you having major shares in that company? If you say yes, tell the shares, or I will give this assignment to somebody else. Very clearly they will say you are having access to insider information. You, your relatives, anybody does any black deals and all, gone, you are caught. Legally not permitted, contractually not permitted. So what will you do? I don't have any other alternative use. What I will do? I will anyway give it to that customer only. What our standard says is, anyway after 6 months also you have to give it to customer only. Now it is only 3 months. Recognize revenue proportionately, provided for whatever work you have done till now, you have a right to receive proportionate consideration. Because if you start recognizing proportionate revenue, ultimately you don't have a right to receive that. You end up recognizing revenue which you cannot collect. The standard puts a condition that you can recognize revenue provided you have a right to receive that consideration. If a contract is terminated midway, a customer should be paying you consideration proportionately for the work done, including your profit margin. If that kind of right you have, recognize revenue proportionately. The last case. Read that. The asset created has no alternative use to the entity, and the entity has an enforceable right to obtain consideration proportionately for the. Because this is about your step number 5. Sir, in this small special cases are there, and step number 1 modification is there. All put together it will take another some 45 minutes or something, that we will take it up in the next session. Okay, but today you can wind up. One small thing you do is whatever we covered, don't do questions also. Just casually scroll the pages and come. What will happen is you will ultimately remember all these points naturally. Once you have that in your mind, all the questions will look like jokers. Out of that 100 questions, you will mark last duration hardly 6 or 7 questions. Rest all are waste questions. They will just enhance your concept. But once you remember all these charts, all these points, logics, you are through. Are questions you don't even need to see. Once you see, do not see them again. Hardly some 8 to 10 questions you will have to mark. That's it. Guys, see you tomorrow, guys. Thank you. So guys, continuing from our Ind AS 115, we have covered all the 5 steps that are there in the standard, except that in step number 1, we are yet to cover the concept of modification. So once we understand modification correctly, in essence, Ind AS 115 is over, subject to few special cases. Special cases are very simple, nothing to worry about that. We'll handle that. But first, so just to give you a quick recap, step number 1, we talked about identifying the contract. In identifying the contract, there are 5 criteria. If all the 5 criteria are satisfied, there is a valid contract in accordance with Ind AS 115. We can go further into step number 2, 3, 4 and 5 and see when and how much revenue has to be recognized. If any one of the 5 conditions is not satisfied, then the standard prohibits you to recognize any amount as revenue. So even though if any of the 5 conditions are not satisfied, but if you happen to receive any money, that amount should be recognized as a liability. But for that 2 exceptions are there. That liability also can be subsequently recognized as revenue, even though 5 conditions are not satisfied in 2 cases. Number 1, the contract is terminated and the consideration received is entirely non-refundable. Second case, the entity has no remaining performance obligations and whether all or substantially all of the consideration is already been received. Then there is a small point about combination of contracts. When multiple contracts are entered by the entity with the same customer or related party of the customer at more or less same time, then if any one of the 3 criteria are satisfied, you have to club all the contracts and treat it as a single contract for the purpose of revenue recognition. That is all that is there in step number 1. Step number 2, we talked about identifying the performance obligation. When we enter into a contract with the customer, we make multiple promises to deliver goods or services. Now, every promise to deliver good or service, it will become a performance obligation provided it is distinct. Now, what is the meaning of the word distinct? There are 2 points you have to satisfy. Number 1, the good or service should be capable of giving benefit to the customer. Plus, each promise that is there in the contract must be separately identifiable from other promises in the contract. If it is separately identifiable, plus it is capable of giving benefit to the customer, that's all. Every promise to deliver good or service is distinct and therefore it becomes a performance obligation. Now, separately identifiable point, how should you test? Now, the standard discussed that in a negative way. You can remember like this. You can understand that the promises to deliver goods or service is separately identifiable from other promises to deliver goods and service if there is no significant integration, if one promise to deliver good or service does not modify good or service in the other promise. Number 3, there is no high interrelated and highly interdependency. If these 3 points are satisfied, then they are separately identified. Clear, sir? Now, what if they are not separately identified? If something is not separately identifiable, you have to club all such promises and club it as a single performance obligation. Clear, sir? That's all that is there in step number 2. Step number 3 is all about transaction price. In transaction price, we understand that whatever entity is estimated to receive, that only is the transaction price and not what is written in the contract. So that is something which is very important. Second thing, in this, what are the issues we have? In this, the issues what we have is, one is variable consideration. Variable consideration you can include as a part of transaction price if collection of such variable consideration or earning of such variable consideration is highly probable. Reversal of revenue chance should not be probable. That's the language used by the standard. That they call it as constraining estimates. If constraining estimates are there, do not include variable consideration in your transaction price. Next, variable consideration ka amount measurement. Two options are there. You can follow either expected value method or most likely method. Whatever you want, you can take that choice. But if the question is silent, then you make a judgment call like this. If there are only 2 outcomes, go with most likely outcome. More than 2 outcomes, go with the most expected value approach, which is probability into each outcome ka summation. That is that. Next, coming to non-cash consideration. If the customer does not pay us cash, but he gives some goods or services or some assets for the goods or services what we are giving, in that case, revenue should be recognized at fair value of such goods and services received that is available. If that is not available, then only you should recognize revenue at standalone selling price of goods and services rendered. This is about point number 2 in step number 3. Next, point number 3 is financing component. If there is a time gap between delivery of goods and services and consideration receipt. Sometimes goods can be delivered first, consideration can come later, or consideration may receive first, goods and services may be delivered later. Any which way time gap exists. If time gap, if it is significant, then you have to recognize a interest income or interest expense. For recognizing that interest income or interest expense, first priority should be given to interest rate applicable in a standalone transaction between entity and the customer. If we both enter into a separate loan giving, loan taken transaction, what rate will be applicable? That is the first choice priority. If that is not there, then go with IRR, which will match your amount with the cash price. That's second option. Right? And the standard gives you a practical experience that if the time gap does not exceed 12 months, you can ignore the financing component. And you should not identify any financing component in 3 cases. Number 1, consideration is received, but delivery of goods and services is at the discretion of the customer. Number 1. Number 2, the consideration is substantially variable like a sales-based royalty. Number 3, other reasons like security deposits and all or credit risk of the customer. Because of this, there may be a time gap, but that is not to be identified as a financing component. That's it. Coming to the last one. If the entity pays any consideration to the customer, then for the consideration what we pay to the customer, you have to go and see, are we receiving any distinct goods and services? If you are receiving, then it is okay. Next question I'll ask you, what is the fair value of the goods and services what we are receiving versus what is the amount I am paying? If I am paying more, that extra amount should be adjusted to the transaction price. Because people manipulate this. That's all there is in transaction price. Coming to step number 4, the entire transaction price must be allocated to all the POs in the contract in the ratio of standalone selling price. That means even any discount offered also naturally will be allocated to all the POs in the contract in the ratio of standalone selling price. So in case if you are able to prove that the discount does not belong to all the POs but only to a specific PO or a bundle of POs, then you must ensure that discount must be allocated only to such a PO or such bundle of POs and not to all the POs. Next, what is the meaning of standalone selling price? Standalone selling price means it is a normal individual observable selling price of each PO. If you are not selling these POs individually, then SASP is not observable. In that case, you will have to go and estimate SASP. For estimating SASP, there are 3 methods given in the standard. Number 1, adjusted market assessment approach. Number 2, expected cost plus margin. Third one is residual method. A residual method is nothing but a balancing figure. If you have to apply residual method, important point is any discount given in the contract must be first allocated to remaining POs. Then only you can take a balancing figure. Without allocating discount to other POs, if you take balancing figure, the entire discount will get adjusted into the balancing figure number. That is something you should be careful. Second thing, whatever balancing figure number comes, that should fall within the range in which the product is usually sold. If it is not falling out of the range, then residual method is not appropriate. You have to identify the SASP using the first 2 methods only. So that is about residual method. Number 3, when you say transaction price must be allocated to POs in the ratio of SASP, transaction price flow, there may be a fixed component and a variable consideration also. So naturally what will happen, fixed consideration also should be allocated to all the POs, variable consideration also should be allocated to all the POs. But again the standard says that if variable consideration is exclusively related to to only a specific PO or a bundle of POs, ensure that variable consideration gets allocated only to such POs and not to all the POs. At the same time, you should not forget the objective of step number 4. Step number 4 ka objective is what? Transaction price should be allocated to POs in such a way that after allocation, the amounts appearing must fairly depict the amount at which individual POs are sold to the customer. If it is not like that, if people are manipulating, then you will allocate the entire transaction price to all the POs, fixed also to all the POs, variable also to all the POs. Clear, sir? This is step number 4. Step number 5 is when to recognize the revenue. There are two possibilities here. That is, control of goods is transferred to the customer over a period of time. In that case, revenue also is recognized over a period of time. If control of the goods is transferred to the customer at a point in time, then revenue also is recognized at a point in time. Now, when to identify whether control is transferred over a period of time or at a point in time. The standard gives you 3 criteria. If you pass any of the 1 criteria in that, then it is understood as control is transferred over a period of time. What is the first one? As the entity performs, the customer simultaneously receives the benefit of it. Number 1. Number 2, as the entity performs the performance obligation, an asset is created or enhanced that directly goes into the control of the customer. Second case. Third case is whatever work we are doing that is creating an asset that our entity has no alternative use other than giving it to the customer. In this case also you can recognize revenue over a period of time, provided you have a right to receive consideration proportionately till date. In that case you can recognize. Correct, sir? Now, if you don't fall into any of these 3 categories, then automatically you are treated as PO satisfied at a point in time. Entire revenue should be recognized at a single point. Correct? Next, if you say that my PO is satisfied over a period of time, then revenue recognition should be done based on measure of progress. And measure of progress, again 2 methods are there: input method and output method. On that we have discussed. Up to here we stand up. Now coming to the modification part. Very simple story. Just understand the numbers correctly. Suppose our company X Limited agreed to. You can open the material, there is a chart, just watch the chart and the example, you link it there, that's it. Agreed to supply 100 units at the rate of 50 per unit to a customer in next 120 units in the next 12 months. At the rate of 10 units per month. Every month 10 units I will sell for the next 12 months. Whenever I sell, he will pay me money. Financing component and all is not there. It is straightforward case. Now, at 6 months time, X Limited also agreed to supply additional 5 units at the rate of 40 per unit for next 6 months. Already I am supplying 10 units per month. Now I will supply additional 5 units per month. But if you closely observe, the price what I charge for original 10 units and the price what I am charging for this 5 units, they both are not same. Prices are different. So what is my obligation hereafter? Another 6 months. According to the original contract, I have to give 10 units per month. According to the modification, I have to also give 5 units. Effectively, can I say every month I have to deliver 15 units? Forget about the price. Unit wise, my obligation is to deliver 15 units. Now, stage or standard asks you 2 questions. Because of the modification, whatever goods and services we are going to deliver hereafter are distinct or not. Plus the consideration whatever you are getting now, that is the 40 rupees per unit one, is at standalone selling price. Now if somebody asks you, sir, why are you selling to that fellow only at 40 rupees? Originally you sold at 50 rupees per unit. There can be 2 reasons. Reason number 1, because he is already my customer, I would have given discount. That is one case. What is the other case? Market prices have genuinely decreased, therefore I am selling at market price only. It coincidentally happened to work in the favor of the customer. Both are possible. Now, tell me, sir, in this particular example, whatever 5 units, whatever extra you are going to supply, are they distinct or not? Are they distinct or not? For that, if you have to answer whether they are distinct or not, first remove from your mind distinct ka meaning is different and a word, you remove it. You understand distinct as different, what will you say? 10 kind of units only you are giving. It is not distinct, and a wrong conclusion you will go. Distinct means whatever we discussed in step number 2. Tell me, sir, if I give extra 5 units, can customer take benefit of that? First point satisfied. Is there any significant integration? Is there high interrelation? Will these 5 units go and modify 10 units per month in the original contract? No, that's all. They are distinct. Don't apply your mind. 3 conditions you see. Distinct means different. Actually, don't remember. Distinct is not different. Distinct means independent, separately identifiable point. You have to test. Clear, sir? Right. So they are definitely distinct. Now, next question is 40 rupees market price or did you give a discount? That depends. Anything is possible. Let us say both the conditions are satisfied. If you say yes, the standard says treat the modification as a separate contract. What is the meaning of treat the modification as a separate contract? It is like you agreed to supply 5 units per month at the rate of 40, not to this customer, to some other customer. How will you account? Original contract per revenue separately you will account. For this separately account. It is like you entered into this modification as a separate contract with some other customer. Don't treat it as modification, treat it independently. Whenever you say 10 units, 10 units, 10 units, 10 units into 50 per unit, revenue recognizing every month, like that. Whenever you give 5 units, 5 units into 40 also recognized as revenue every month. So don't mix the original contract and modification part. A modification part is a separate contract altogether, because if this is not this fellow and some other guy also, I would have sold at the same price. That's the whole point there. So E case will not come in the exam because there is nothing to do here. It's a very obvious case. If you say no, if you are saying no here, what you are saying is either goods and services are not distinct, or you are saying that goods and services to be delivered are distinct, but consideration is not at standalone selling price. It could be either of them. Then we will ask you, remaining goods and services to be delivered are distinct is the next question. If you say yes, that means what, sir? Remaining goods and services what I am going to give, they are distinct. That means what? Price is not at standalone selling price. What our standard says is treat modification as number 1, cancellation of original contract. So you treat as if original contract is gone, plus our entity has entered into a new contract. New contract for what? New contract for entire remaining performance obligation. What is the impact of this? The total contract originally is for how many months? 12 months. How many months is over? 6 months is completed. After 6 months, we agreed to supply some additional goods and services also. So what is my obligation now? For the next 6 months, what is my obligation? Every month I have to deliver 10 units also, 5 units also. Actually, there is a original contract, this is a modification part. What our standard says is mix them like this. So for the next 6 months, our obligations are like this. Sell 10 units per month at the rate of 50 per unit into 6 months. Total is 3,000 plus. Also sell 5 units per month at the rate of 40 per unit into 6 months. 1200. If you total it up, what is the total amount now? 4,200. Tell me how many units I have to sell now? 15 units per month into 6 months is equal to 90 units. So it is like you entered into a contract to sell 90 units for the next 6 months at the rate of 4,200. So that means for every unit, how much revenue are you agreeing now indirectly? 46.67 per unit. Whenever you deliver each unit, you go and recognize the revenue of 46.67. This is what you will do. Are you understand, sir? This is called as original contract gone, new contract entered for remaining obligations. Original remaining, new. Both put together, whatever remaining pending obligations are there, treat them as a single contract hereafter. That means indirectly we are asking you to average the price and recognize the revenue. That's it. Suppose you say the remaining goods and services, whatever we are going to deliver, is not distinct. You say that they are not distinct. In that case, standard says perform a cumulative catch-up adjustment. Cumulative catch-up adjustment is nothing but this is a retroactive treatment. Let's put up an example and then we will develop a story on this. The example will not work for that. Why it will not work for is in this modification, definitely I have to deliver 5 units extra. Our 5 units are capable of giving additional benefit to the customer. Our 5 units are definitely distinct from the original 10 units. So, in particular example, whatever we have taken, that will not be useful for discussing this last case. We have to take some other story. Okay, watch this. Sir, my customer has a house. That fellow gave me a contract to provide interior services. So we made 6 promises, or let's say 5 promises we made. Some kind of flooring we promised, some kind of painting we promised, some kind of furniture we promised, some kind of lighting we promised. Okay, 5th one I will add it separately. So 4 promises are there. Tell me, sir, even though 4 promises are there are 4 POs, single PO. Single PO. Why? All the 4 are going to be integrated. Definitely they are going to be mixed to deliver a interior properly designed house, isn't it, sir? So, even though there are 4 POs, this is a, 4 promises, it is a single PO. Now, our company estimated that to finish this entire work, it will take 200 hours. And for this, customer will pay us a revenue of 10 lakh rupees. For doing this entire job, customer will pay 10 lakh rupees. Now, till date, 120 hours work is complete. Apply input method and tell me what is the degree of completion. Various costing cuts are. Input method is not cost always. Whatever you input, that could be hours also. So tell me, sir, degree of completion. 60%. Percentage of completion is 120 upon 200 into 100, which is equal to 60%. Which means revenue already recognized till date is total 10 lakhs into 60% is equal to 6 lakhs revenue already recognized. Work another 40% is pending. We have to yet to do. It will take some more time. Meanwhile, modification happened. My customer saw some model house on Instagram or in Pinterest. He brought it to me. Sir, in this house, they have fountain inside the house. We also want that. I want a water-based decoration inside the house. As I am walking below, under the floor, water should be moving. No, it's there. I am not joking. Okay, so it's there. Fellow says, I want that. Can you do it? So yes, definitely. Why not? Only thing is, price will increase and number of hours to be given also will increase. So what I quoted is, for this modification, we need another 50 hours. And Revenue, originally we agreed 10 lakhs, now you have to update it by another 3 lakhs. Revenue increases there, number of hours increases there. This is definitely a modification, there is no doubt in that. Now the question is, because of this modification, I have to do some extra goods and services now, extra service I have to provide. Is this extra service what I am going to provide? Is this distinct or not distinct? Is this distinct or not distinct? So because of the fountain what I am giving, customer is definitely going to get benefit. There is no doubt in that. But is it separately identifiable from other promises? No. It has to be integrated into a well furnished house, isn't it? That means even though I may be doing some extra work, that extra work is not distinct. It is part of existing PO only. So whatever standard is saying, go into a cumulative catch-up adjustment. You know what is the meaning of cumulative catch-up adjustment? Go and work out degree of completion again. Because of this updation, whatever you already recognized may not be correct. Go and revise it. It's not like I'm accounting for this modification. I'm accounting for what I have wrongly done already. Because of this modification, my already recognized revenue is wrong. So I have to update it. How to update it now? Tell me, sir. What's the work done? How many hours did you put in? 120 hours. But overall work is now how much? 200 plus 50 hours. 250 hours. Into 100 you do more? 48%. 48% is a measure of progress, but originally you recognized 60%. So there is a change. Now tell me, sir, what is the revenue that can be recognized till now? Revenue till date. You are having a right to recognize. Originally promised consideration is how much? 10. Plus now you are also increasing by 3. In 13 lakhs, 48% you have a right to recognize revenue, which is how much? 24,000. But already anyway we recognize how much? 6 lakhs. So I have to further recognize immediately a revenue of, that's it. This cumulative catch-up adjustment. So because of this, sometimes revenue has to be recognized, sometimes revenue has to be reversed also. That is also possible. The cumulative catch-up adjustment is nothing but the way in which you do your ESOP's calculation every year. ESOP calculation, how are you doing? Cumulative till date, how much should be my closing SBP reserve minus what is already recognized in the previous, and net amount you book it off in the current year, correct? Exactly same story. This is cumulative catch-up adjustment. You observe, sir, the cumulative catch-up adjustment, why did they give? Because there is no other option. I cannot do it any other way because our remaining POs are not distinct. Our remaining PO key, separate revenue recognition is not possible. They are still part of existing one single PO only. I cannot account for this separately. I have to mix it with the original one. Whereas in the second case, where we asked you to treat it as cancellation of the contract and a new contract is entered, there I cannot do cumulative catch-up adjustment because whatever revenue I already recognized in the past, that is not wrong, that is correct. Hereafter you do a average revenue recognition because the goods what you are going to deliver is distinct and you gave discount to that fellow because he is already your original customer. It is like for the discount, for example, originally I sold it for what rate? 50. But now I am agreeing to sell it only for 40. Distinct goods say. This is not standalone selling price. If it was standalone selling price, you would have fallen in the first category. You are falling into this category means what, sir? Goods and services you are delivering is distinct, but price is not standalone selling price. That means you are giving him discount because for that extra goods you already indirectly collected money at the first sale only. Therefore, you have to do an average pricing. That's why when you do everything, you got 46 point. If you peacefully keep this example in your hand, perfectly everything will sync. That's what we have written here. The chart is that, sir. Cumulative catch-up, termination of old contract and creation of a new contract, account modification as a separate contract. These are the three ultimate outcomes of your modification story. Right? Now coming to special cases. Special cases, if you are important for the exam actually. Come to special case number 1, which is warranty. Page number 34.14. Warranty. Now, warranty, whenever you sell any product, the seller gives warranty to the buyer, the customer. The warranty, two types of warranty will be there. One is a warranty which is inseparable from the goods. For example, you buy a TV. You purchase a TV whose price is 8 lakh rupees, big TV. Even though you buy a TV worth 8 lakh rupees, Samsung fellow by default gives a warranty of only 1 year. 1 year warranty. Sir, I bought a bigger TV, no sir, can't give you 10 years, no. But, so the Samsung TV is sold only along with a warranty of 1 year. When you buy it from Reliance Digital or Chroma, Samsung TV is sold to you only with 1 year warranty. But the customer ki, the Reliance fellow, the seller, what he will tell is, sir, 8 lakhs TV you bought. Usually in the first 1 year, no problem will come. New TV only, no. So by the time problem comes, the warranty will get expired. So we are selling additional warranty. We will cover your product for another 5 years, provided you pay extra money right now. So what is this seller doing? He is selling product along with 1 year warranty that is not separable. But he is also selling extra 4 years additional warranty. 2, 3, 4, 5 years are also covered, provided if the customer pays extra money. So there are two types of warranties now. One is the warranty which is not separable, that is called as assurance type warranty. The warranty which can be separated, where the seller is taking money and giving you a guarantee that if any problem is there, I will come and repair it. That is called as service type warranty. There are two types of warranties. So how many POs are there? 2 POs. One is sale of TV along with 1 year warranty. They both cannot be separated, because if you tell the Reliance fellow that, sir, I myself am TV mechanic. If anything comes, no, I can handle it. I don't want that 1 year also. Remove it and tell me what is the price. Will you sell like that? A 1 year warranty which comes with a TV by default, that cannot be separated. They both should be treated as one performance obligation. The extra 4 years warranty service, whatever you are providing, that is another performance obligation. Overall consideration, whatever you are receiving from the customer, should be allocated to both the POs in the ratio of standalone salary. Sale of TV is something, a performance obligation which is satisfied at a point in time. The moment I deliver the TV, install it, khatam, over. I can happily recognize that portion of the revenue. Whereas today I received 40,000 rupees for providing him warranty for additional 4 years. That kind of money is relating to a service which is to be delivered to the customer over a period of time. So 40,000 rupees will be booked as revenue in second year, third year, fourth year, fifth year, over a period of time. Are you understanding, sir? Next. If you observe closely, you identified only 2 POs. One is 4 years warranty, one is sale of TV. Sale of TV, whatever you allocated, in that warranty 1 year is also included. So when you recognize entire sale revenue in the first year, correspondingly cost of goods also will be booked. But a 1 year warranty also some amount is collected. For that, correspondingly you have to create a provision for warranty. Ind AS 37 lo whatever provision for warranty is there, that is for assurance warranty. A provision you have to do. Clear here? Assurance warranty ki revenue is not separately recognized, part of sale of goods. So in the year in which goods are sold, the entity has to estimate the overall cost of warranty service and recognize the provision in accordance with Ind AS 37. So this is about warranty. Next one is non-refundable upfront fees. So it's like this, sir. When you join any entity and for example you join a gym normally annual package or monthly payment you make. But for joining in that gym, what he says is, sir, ours is a elite gym and all. Not everybody, it's not for everybody. If you want to join here, monthly anyway we will take 2,500 from you. But first day you have to pay 1,500 as membership charge. Then you'll ask him, sir, for paying 1,500, what will you get? Take hand. Welcome to the club. So I am collecting money from the customer, 1,500, but I am not giving him any distinct goods and services other than shake hand and a small ID card kind of thing. Am I providing any distinct goods and services? No. Indirectly what is happening, you simply looted the customer and we don't have any obligation to perform anything for that. In that case, entire amount is recognized as revenue immediately. Sometimes what happens is, sir, you pay 1,500, we will give you a kit. In that, one sports jacket, water bottle, wristband, headband, all these things will be there. A sports gear, or while doing the gymming exercises and all, whatever minimum gear you want, that they will give you. Alt-fit ka t-shirt will give you, one shorts will give you, one headband will give you, and small bag to carry all this small water bottle. For water bottle, it's beyond that you are not supposed to drink, so you planned it like that. When you have any distinct goods and services you are getting, in that case, recognize revenue when that bag is offered to the customer. Whenever the distinct goods and services are given, then you recognize. Nothing is there, recognize immediately. Very simple for coming in the exam. Next one. Principal versus agent. Sometimes goods are sold by somebody who is not the real owner of the goods. In that case, the customer pays money to that person and not to the original owner. This is nothing but, I am the owner of the goods. You are standing in my godown. Whenever customer comes, I will direct it to you. Customer will give the goods, customer will pay money to you. Just because you are receiving the money, it does not make you the seller. You are entitled to a particular amount of commission, but entire remaining amount you have to pay it back to me. So, it's a story of principal and agent. General concept everybody knows that principal key, entire gross revenue, gross amount should be recognized as revenue, whereas agent should recognize only commission as revenue. As a principal, everybody understands this. In this, nothing complication is there. But in some cases, whether you are a principal, whether you are an agent, clarity will not be there. In that case, you have to apply the guidelines given in the standard and establish whether the entity is a principal or the entity is an agent. How they define is single lines. A small box is there in between. Read. You are understood as a principal if you are controlling the goods and services before they are handed over to the customer. That party who is having control over the goods and services. Control means decision making power. That fellow is called as principal. And the standard also gives you certain criteria also, indicators. Look at the first criteria. Indicators that entity is a principal. Our entity is primarily responsible to perform the promise, number one. Number two, inventory related risk we only have to bear as a principal. Next, entity has discretion over the price at which goods and services are to be supplied. Price setting power, whoever is having, that fellow is principal. If goods are not sold, our risk who will face? That fellow is principal. Who is ultimately supposed to deliver the promise? That fellow is principal. Next, the entity is exposed to trade risk. I sold goods on credit, customer does not pay. Will the commission agent will be sad? No, he already received his commission when goods are sold. Who will be sad? Owner will be sad. So that person who is facing inventory risk, credit risk, who is primarily responsible to fulfill the promise, and that person who has discretion of setting the sale price, these four indicators, whoever is having, that guy is principal. For this only I wrote negatively and I called it as agent, because question of which type of question it will come we do not know. So four criteria remember. Important, sir. On this one, airline ticketing type question is there. It's a very good question. This fellow is normally, he is booking tickets for the customers. Customer asks, I want to fly from this city to that city. I'll book a ticket, I'll collect 500 rupees extra. This is a job. I'm an agent, ticket booking agent. But this fellow got greedy one time. What he did is, entire summer kit, 100 tickets to Europe he purchased with an airline on his own account. Customer is not there. March to June, anytime people will fly, I want 100 tickets, and he contracted with an airline and I purchased tickets on my own account. Imagine I am the agent normally, but this time I purchased tickets on my own account. What is my idea is, in December month I will get tickets at a cheaper price. As the time goes near, as the summer arrives, prices will shoot up. I purchase each ticket at 80,000 rupees. I know that by peak summer, ticket price will go as high as 1,50,000. So my idea is, let us buy it 80,000, reserve everything and keep. Wait till March or something. In March when people are buying tickets, other airlines and all will be selling at 1,50,000, but I purchase only at 80, I will be happily selling at 1,10,000 only. And make a decent profit. This is not good. But basically I am an agent, but this is not an agency thing, because I purchased the ticket on my own account. Imagine, sir, in March month if customers do not travel, who will face that risk? Myself. Suppose other airlines did not sell tickets at high price, they are selling at 70,000 only, because there is a decrease in the fuel cost. Then what? But I already purchased it 80,000. I am also forced to sell it below 70,000 now. So what will happen now? I'll suffer a loss. Who is having the risk? I'm bearing the risk. Are you understand, sir? Next thing. When I sell the ticket to the customer, am I primarily responsible for fulfilling the promise? What is that obligation? Ticket will give you what, sir? A right to fly. So, when I sell a ticket to the customer, I am prima facie responsible to give him a right to fly. That's all. My goal is not to take him from Hyderabad to London. That is not my goal. My goal is only to ensure that he gets a boarding pass correctly. Whether he is happily going to London or he is fighting with the air hostess inside or he did not like the travel, that I do not know. My goal is to get this fellow into the flight. I am primarily responsible for it. The customer key, imagine I sold ticket on credit. Customer said, after coming from London, I will pay. He did not come back ever. RSK only has to bear no. That means even though normally my business is agency business, but in this transaction I am a principal. That kind of one question is a good question. This we will talk later. Next one. Sale with a right to return. Sale with a right to return, meaning, suppose, sir, we sold 100 units to a customer. We told the customer that in the next 1 month, any time if you don't like the goods, you can return the goods either in full or in part. Customer paid his money completely. Let us say he paid 20 rupees per unit. This is selling price. Side by side I am writing, cost for us is 15 rupees per unit. 100 units is sold. Since you sold goods, definitely you will receive money. The bank account debit. 100 units into 20 rupees per unit is 2000 rupees you collected. What our standard says is, the customer is capable of returning the goods anytime, but still we can recognize revenue to the extent of goods you believe that customer is going to accept. He can return the goods anytime, but based on past experience, if you can estimate that customer is going to retain some amount of goods or accept some amount of goods, to that extent happily you can recognize revenue. So, two sales, let us say 100 units, we believe that customer is going to accept 70 units. 70 units into 20, 1400 revenue recognized. Cash is received, but revenue booked only 1400. Amount received and cannot be recognized as revenue for 600. This automatically will be recognized as a liability only. This is for how many units? 30 units into 20 rupees. That means even though you handed over to the customer 100 units, you believe that 30 units are going to come back. 30 units are not sold and a feeling, so you recognize the entry. What our standard says is, to the extent of units expected to be accepted by the customer, recognize revenue only to that extent. Clear? Done. Now in this one small problem came. What is that? In my P&L account debit side, you imagine purchases is recognized at 15 rupees per unit for all the 100 units. But P&L credit side, I am recognizing revenue only for 70 units. There is a mismatch. Cost is booked in P&L for all the units. Revenue is recognized only for 70 units. The standard says you will recognize another entry now, which is right to recover, because even though you handed over 100, you believe that 70 only are going to be accepted, which means that 30 will going to come back. No, 30 units into, what is the cost price now? 450. 450 rupees goods are going to come back. So that recognize an asset and credit this off to your, this is nothing but indirectly inventory, sir. Nothing but indirectly stock. What is the entry for closing stock? Stock account debit to P&L account only, no? Same thing. Only thing is, this is an inventory lying at customer's location. It is ours own, it will come back. Suppose, next month, exactly like how you anticipated, 70 units he kept, 30 units he returned. What will you do? If exactly this happens, what will happen? Tell me. You already created a liability, pay it off. Liability account debit to bank. 600, 600. Done. Plus, he returned your goods back, put it back into your proper inventory stock account and kill the right to recover goods because you already received the goods. Clear, sir? Suppose instead of this something else happened. That fellow kept all 100 units with himself. What will you do? Then whatever liability you created, that is not liability. Book it as revenue. And whatever right to recover goods and entry, whatever you wrote, entry you reverse it. Entry when you reverse, what will happen? Pain level, cost will get booked. A liability is not recognized as revenue. Matching. You understand? It's a 600 revenue you are recognizing, 450 cost you are booking. Net profit is how much? 150. Profit per unit is 5 rupees. 30 into 5, 150 rupees. Matching will happen. Are you understanding, sir? So a revenue adjustment can happen depending on change in estimates. That is one case. Consignment is very simple. Bill and hold arrangement is again important. Bill and hold arrangement means customer paid the money, but customer asked us to deliver the goods at a later date. That means we sold the goods, customer paid his money also, but customer says I will not take delivery now, I will take delivery at a later point of time. It's called as bill and hold. We billed the customer, we collected the consideration also, delivery did not happen. Can I recognize the revenue? Delivery did not happen. And it says you can recognize revenue if control over the goods is passed on to the customer. Physically goods are with us only, but control should be passed on to the customer. Then you can recognize the revenue. So, sir, how will you know whether control is passed on? For that criteria is bill and hold arrangement request should come from the buyer, not by the seller. Number one. Number two, goods must be ready for delivery and separately identified towards the customer. Goods say not there. Customer gave me money. He says, sir, I will take after 1 month, sir. Okay, sir. But goods are not there with me. I cannot recognize revenue. Goods must be ready for delivery. Next, our goods must be separately identified towards the customer. Number 4, the entity, the seller entity should not have any discretion over these goods. We should not have any decision making power. Some other customer comes, take these goods, sir. Our customer again I will. No, we cannot do that. You should not be playing with these goods. You just have to keep it aside. If all these points are satisfied, the standard says control over goods is transferred to the customer. Happily recognize revenue. Clear? In this one more small issue is there. What is that? So quantum of the goods is 10 lakh rupees sale. Customer paid me money. Customer says, sir, I will take the goods after 1 month exactly. Timing, store it with you. 1 month, okay, normal time. Customer tells me, sir, I will buy the goods 10 lakhs, but whenever I want, I keep on picking, but goods you will be having in your godown only. I will not take delivery at all. Whenever I have to sell these to my customer, directly from here only I will sell. So now I feel that this customer key, I am giving sale of goods plus I am also providing custodian services. Custodian services means I am safely keeping his goods for an estimated period of, let's say, 9 months or 1 year or something like that. That means how many performance obligations are there? 2 performance obligations are there. So overall sale price, whatever the customer is giving, the transaction price, that must be allocated to both the POs. Sale of goods also, custodian services also. Here, sir, this is one case. Customer study matter, this is not the way to honestly bought. Next one, licensing. Let us say I am a production company. I made a movie. After making the movie, I sold the right to display the movie, OTT rights to Netflix I sold. I am the producer. I am giving a license to the OTT platform to display my movie. The movie will be released in theaters. After 30 days of release, the movie will be displayed in Netflix. Before movie release, me, the producer, director, and the cast and crew of the movie, we are all doing promotional activities everywhere. Just because I do promotional activity, the content of the movie, is it going to change? Promotion is for what purpose? To get crowd into the theater in the first 1-2 days. First weekend you can do your drama and all. But no matter what you do, people will not come to the theater if the movie is bad. Nobody will watch the movie even on OTT, even if it is free also they say people are not watching. If the movie is not good, correct? Your own favorite star, movie is not good, will you watch it? Not everybody watches. So, I have sold the intellectual property right to Netflix and I am doing so much of activity, but no matter what I do, the functionality of the product is not going to. This is understood as transfer of goods or service at a point in time, because whatever I sold, I already sold. No matter what I do hereafter, the content is not going to change. The functionality is not going to change. Since the functionality is not going to change, whatever is there, that only you should display and use it. So that means entire performance obligation is treated as satisfied at a point in time. In this case, our standard calls it as right to use intellectual property. Right to use. See the word right to use. When will you use something? It is already ready and no further changes will happen. As it is, whatever is there, you have to use it. Next, another example. Let us say I am a producer of one old classic movie from 35 years back. Music director Ilayaraja. That fellow made one song. A song rights I have. Now you are a TV commercial. Sir, in our ad, that hero will be singing a song, sir. Raja Sir ka song. But you have rights. Kindly give us the rights so that we will use that song here for the next 2 years. No problem. Pay me 10 lakh rupees. I took 10 lakh rupees and I sold the song correct. That hero will hum that song in the ad. And that company can display this ad for next 2 years. I sold the right. Now, after I sell the right, there is some controversy regarding behavior of this music director outside. He has done something very bad or something, he is caught in some fraud case or something, whatever happened. No matter what happens, how he behaves, how he performs on the stage, he is unable to sing, his movies are flop now. Will it change the utility of song what I already sold? Because no matter what we do, the functionality of what I already gave to you is not going to change. That is static. Something which is static, something whose utility is not going to change irrespective of my future conduct, that is called as right to use kind of IPs. There is another category now. That another category is called as right to access. Right to access is a scenario like this one. Understand? Let's say I am the owner of a IPL franchisee. Let's say Mumbai Indians, I am the owner. Nike fellow is making sportswear. What he told is, sir, we will make team jerseys based on Mumbai Indians, Rohit Sharma, all these numbers and all, that fellow's cricket gear number and all, I will put, we will manufacture shirts and we will sell. Can they volunteer without my permission to Mumbai Indians and they can print a shirt? No. My permission is required. I told that, pay me 10 crores, I will give you license to manufacture shirts on name of Mumbai Indians for the next 5 years. Fine. That Nike fellow paid me 10 crores, I gave him a license. Now hereafter imagine, what Nike will expect? Will expect that Mumbai Indians should play well. Will expect that or not? He will also expect that this team should hire proper players. In auction we should spend lot of bomb money and bring all good players. Our company should always go to the final, and Nike fellow will estimate or not? He cannot put it as a condition, but he will expect that. If all whatever he is expecting is happening, what will happen? The craze for this team will increase, shirts will be sold. That means the fortunes of the franchisee is directly linked to the performance of the franchisor, isn't it? If the team performs well, shirts will be sold. Imagine, sir, Mumbai Indians got caught in a fixing scandal. Team got banned for 2 years. What will happen? Will you buy a freshly Mumbai Indian shirt and wear and roam on the road? Instead of signing happening players, good players, they are hiring retired players. There is another team already competing for that. So the minimum qualification for entry into the team is 35 you should be. Then only they will buy. That kind of team they are building. Charm is lost. Youngsters, will they buy that shirt? No? That means depending on the performance of the franchisor, a franchisee ka fortunes and sales are linked. This means that fellow is directly exposed to risk and rewards of our performance. This is called as right to access. The first one is right to use. This is right to access. When you say it is right to access, that means PO is satisfied over a period of time. Revenue recognition also should be done over a period of time. So you have to observe case to case, sir, and ultimately whether the license is a డైనమికా స్టాటికా? స్టాటిక్ అయితే రైట్ టు యూస్, డైనమిక్ ఓవర్ పీరియడ్. Then sale and repurchase. Sale and repurchase. Sir, I first sold in sale and repurchase again. 2-3 cases are there, but easy only overall. I am X Limited. The seller, the original seller. We sold goods to a customer. Customer also paid us money of 10,000. At the same time, I entered into a concurrently another contract that after 1 year, we will repurchase the goods and pay some consideration to the customer to whom I sold goods today. Imagine case 1, consideration is 12,000 rupees. Watch this correctly. I sold goods, but the goods are anyway going to come back. Goods are anyway going to come back, and I am going to pay how much? 12,000. If nothing is given, what people will do? First recognize one sale transaction. After 1 year, go and recognize a purchase transaction. Sale is also there in your P&L account. Purchase is also there in your P&L account. Effectively, you will book a net loss of 2,000 rupees. If nothing is happening, nothing is guidance is given to you, you will recognize that sale separately, purchase separately. But India is 115 says, wait, Babu, wait. Let me see what are you doing. First you sold goods. After 1 year, the goods are coming back. That means effectively goods are not sold. Then why did you do all this? Loan. Today I need money. I collected 10,000 from you. After 1 year, 10,000 rupees I am repaying to you along with. This is a financing transaction. Can't you take loan directly? Why are you doing all this drama? These goods are given as security, sir. These goods are given as security. When I take loan from somebody, the other fellow will ask security. No, security guy, go handed over goods. Then still you can account it as a loan. No? Why to disguise like this? I wanted to manipulate sales also, sir. Now that I got caught, part 115 says, shut up and recognize it as a financing transaction. Tell me the entry for this. X Limited point of view. Bank account debit to loan 10,000 after 1 year. Interest expense account debit to loan 2,000. Then loan to bank 12,000. Are you understanding? Easy only. Reverse case. Price is not 10,000. Price is 9,000. You cannot call it as a loan now. If you are paying more, then loan. If you are paying less, it's not loan. What is this? Lease transaction. I gave a machinery to a customer. Customer gave me 10,000. After 1 year, I got back my machinery, but I paid him only 9,000. That means what? How much am I not paying? 1,000. Why am I not paying? He used my machinery. Means it is a rent what I am collecting from the other part. The lease transaction. So, in any sale and repurchase transaction, the ultimate answer will be either the sale and repurchase must be identified as a financing loan taken transaction, or it will be identified as asset given on lease transaction. So how generally I ask people to remember is, look at the prices. See, you are only bothered about this company, sir. You are only bothered about X Limited. Don't think from other fellow's point of view. We are not accounting for the customer. We are accounting for the selling entity. If X Limited is paying more, that is interest cost. Interest will be there only in a loan. If X Limited is paying less, we are getting benefit because somebody else is using my asset. Therefore, it is a lease transaction. This is a case of sale plus repurchase fixed. In this, another variant is also there. Sale happened, but repurchase, whether it will happen or not, it is at the option of the buyer or at the option of the seller. This is only nothing but call option and put option. Sir, call option, put option, what will you do? Simple. X Limited, wait a moment. X Limited sold goods to the buyer, and buyer I gave a put option. What is the meaning of put option? Buyer has a right to sell. In case he exercises this option, what will happen? The goods will again come back to us. If he sells, we have to repurchase. Here also answer is same only. Answer will change, same answer. Only thing is you have to just once also check whether if put is likely to be exercised or not. Put is likely to be exercised. If put is likely to be exercised, then only a goods will come back. If put is not likely to be exercised, goods are not going to come back. In that case, happily recognize full amount as revenue. Put is likely to be exercised, then goods are going to come back. So sale is not there. Then what is there? That depends on the amount. 12,000 if it is there, loan. 9,000 if it is there, lease. Instead of put option with the buyer, you can also frame this question as call option with the seller. Call option is a right to buy. They case, they stupid story. Financial instruments, derecognition also we studied. Financial asset I sold, again I agreed to repurchase it. Or I have call option, put option, deeply in the money. We studied all this. Where financial instruments, derecognition of financial assets, special cases, so this is there. Again, that is there here also. Goods case. And the manipulation stuff, sir. This is easy only, you can handle. Now coming to service concession arrangement. It's a very simple stuff, very, very easy one. Service concession arrangement means for example, government gave our company a contract to build a national highway for a 200 kilometers road. 200 kilometers road ka contract we got. Actually, laying the road is whose responsibility? Government ka responsibility. Government also has so many public sector undertakings who can do this job. But luckily, I am a private contractor, I am friend of the government, they gave that contract to me. For doing all this job, I need some money also. I am not going to see. Government will do freely for the public. Why will I do? I will not do. I want money. Who has to pay me money? Government has to pay. The government can pay me this consideration in two modes. Number one, they will agree to pay cash. Sir, you do the work, we will pay you cash. For a period we will pay, remaining last we will pay. That means, for the work what I am doing, what I am going to receive from the government is money. If money is what you are going to receive, ultimately you end up recognizing a financial asset. Possibility to. Government says that you construct the road with your own money, will not pay you anything. But once the road is complete, for the next 20 years, stand on the road, whoever is passing by, collect money from them, toll. Toll collecting license they are giving. Since, do I have a right to collect money from the government now? I don't have a right to collect money from the government. Therefore, for the work done, I'll recognize revenue, but correspondingly I can't recognize a financial asset, but I should recognize a intangible asset. What is intangible asset? A right to collect the toll. So, normally in real life, what will happen is, imagine sir, the construction period is 5 years. After that, another 20 years is road maintenance contract. Total 25 years project. 5 years of construction. My entire work is happening during 5 years only. So when as I incur expenditure will be booked in P&L account. In that there is no doubt. Work is happening over a period of time. Since work is happening over a period of time, most likely revenue is also recognized over a period of time. For that I apply measure of progress. Right? So first year some revenue, second year some revenue, third year some revenue, fourth year, fifth year I recognize revenue. When I recognize revenue, what is the entry you are writing? Credit part is to sales revenue. Revenue from construction services. Okay. Debit what? If you debit, no, because if you are receiving it is cash. If it is receivable, then if it is cash receivable from the government, you will have to create a financial asset. If government is going to give you ultimately a license, then you have to create a intangible asset. That's all that is. Sir, I am constructing road. No, sir. This road also our books. No. Road is yours, sir. Road is not ours. Our road is belong to government. You cannot capitalize that road. You incur expenditure, you have a right to receive money. Money you recognize as an asset, not the road itself. The infrastructure what you are building, there is never should be coming into your books of accounts. Now, the ICAI study matter one question is there. That question only came as it is in the exam also. Our question also E-entry only they wrote. But practically E-entry is wrong. Real life. If you read study material fully, you will understand what is their intention and all. People don't read because study material is very fat. Original story is The entry when will you write? Only once in lifetime, every year. Why once? After 5 years ki put together, you will recognize sales at the end of 5th year. You will recognize every year. But 5 intangible assets will get. How can you recognize intangible asset every year? Intangible asset, particular license, sir. When will you recognize intangible asset? When it is ready for usage. When will it be ready? You can collect toll from first year only. From the workers who are moving, you will ask toll. After 5 years, no intangible asset you should have. And if you look at the answer here, whatever is printed in study mat, they wrote this entry. 100 is a second thought, 100% wrong. 100% wrong. But why they wrote that entry is, in the question that is here in the ICAI study mat, they asked you to write a gross entry. All 5 years ki put together write an entry. Why sir, year on year I want to write it. Numbers are not given in the question. What will you do? Numbers if they are there, then we will write correctly only. Numbers are not there. 5 years ki overall revenue, overall cost he gave. He is asking write entries. What option do I have? 5 years ki combined entry I wrote. Directly they recognize it like that. Answer is not wrong. But in reality what will happen is, whenever you book sales revenue, correspondingly you will have to create a dummy asset called as contract asset account. At one day government will say, I will pay you money, you can collect money on this date. For now, a contract asset I will cancel and I'll recognize a financial asset. Or when the project is totally complete, I will directly recognize a. In reality, this is what will happen. Study matter whatever question is there, and 5 years ka put together gross entry. So that fellow wrote this entry. You should know why you are writing this, but you should also know that this is not the entry you will write every year. For question a small tweaking they make. Instead of 5 years, they give you 3 years construction, and each year cost and all they gave you. You go and write this entry, you are gone. Intangible asset every year, how can you recognize, sir? You have a right to collect toll only after 3rd year. Every year, a dummy asset you have to create. 3rd year annual dummy asset will die, intangible asset will get created. The original story of this. Here, that's what I wrote here. Then revenue recognition proportionately will happen because as you construct, the road is going into the control of the government. Definitely it is accepted over a period of time. When revenue is recognized, initially create a corresponding contract asset. If it is an amount receivable, create a financial asset by cancelling the contract asset. A financial asset, how to account, sir? Ind AS 109, sir. If consideration is a right to recover money from the public, then recognize a intangible asset. Intangible asset will again be covered under this. Because this is the entire story of your 115. Guarantee, sir. If government is guaranteeing amount, means that is financial asset only, no. Government says, I am going to pay you some amount, means what, sir? It is definitely a financial asset. I'll show you the question, why to worry. Don't know. If you remember question like that, you are pro. Then I should respect your question. No, wait. Okay. ANM is the business of infrastructure, has 2 divisions, toll roads and wind power. The brief details of these businesses and underlying project details are given. First one, Bhilwara Jabalpur toll project. Look at this fellow's talent. He called here a toll project. Looking at that word, toll, immediately in our mind what will come? Intangible asset will get. Wrong answer. The company has come, the toll project for government, sir. You don't get a right to collect toll there. Whether you have a right to collect toll or you have a right to ask money from the government directly, that depends. You have to read the question. The company has commenced the construction of the project in the current year and has incurred a total expenses aggregating to 50 crores by the end of the year. Under ICAI, the company has recorded such expenses as intangible asset. The brief details of concession agreement are as follows. The total expenditure on the project is 100 crores. The worth of the service is 110 crore. That means for constructing this entire road, ideally, considering time value of money, everything and all, ideally I should recognize an amount of 110 as my revenue. That's the meaning of that. Total cash flow guaranteed by the government under the concession arrangement is 200 crores. Look at this. Cash flow guaranteed by the government. That means what? Government is promising to pay me an amount of 200. But for the service, construction service work, I deserve how much? 110. So 200 they are going to pay. In that 110 rupees is towards what? Construction service work. And the government is paying me extra how much now? 90. Remember that. Continue further. Finance revenue over the period of operation phase is 15 crores. What is finance revenue? Sir, entire first year I did work. I have a receivable. But government is not paying money in the first year. They say I will pay directly at the end of second year. Second year ending. That means there is a time gap. Since there is a time gap, I will recognize interest income also. And interest income also government has to pay. That interest income is calling it as finance revenue. So 110 is for the construction work. 15 is for delay in payment. So 110 plus 15, 125. So 200 lo 125 remaining is how much? 75. He says that other income 75 relates to services provided during the operation phase. Once the road is complete, I have to do maintenance services. For that they will again give me 75. So overall the government will give me how much? 200. Now it 200 is split. 110, 15 and 75. But 110 is a contract, sorry, it's a financial asset only, no? 75 is also financial asset only, no? So 15 is also financial asset. Why? Government is going to pay me cash. Since the government is going to pay me cash, I have to recognize a financial asset account debit to revenue. In reality, what will happen is you will recognize contract asset account debit to revenue. Whenever money is recoverable, at that time, kill contract asset and debit a financial asset. But in this sum, year on year data is not given. But the fellow is still asking entries. That's why in the answer you see what did the rate. Financial asset account debit to construction with an amount of 110. And then again, interest income entry. Ind AS 109, interest income, what is the entry? Financial asset account debit to interest income entry. During the maintenance period, again recognize revenue of 75. Financial asset account debit to revenue this time. This is maintenance work with revenue, another PO. Overall financial asset 200 is paying me. Recognize. That's simple. Are you understand, sir? If government is guaranteeing me cash flow means it is a financial asset. In this another part is the second part. He says, Kolhapur-Nagpur Expressway, the company has also entered into another concession agreement with government of Maharashtra and the current the construction cost for the said project will be 110 crores. The fair value of the construction cost is approximately 200 crores. This is basically the amount of revenue. The said concession arrangement is a toll-based project and the company needs to collect the toll from the users of expressway. We have a right to collect toll. Right to collect toll means what, sir? That is an intangible asset. If you look at this case answer, intangible asset account debit to. So this is how you have to do. Sum nothing is there. It's a very simple sum. 1 2 items back question came for 8 or 10 marks. So this question. Names they change. Numbers are also more or less same only. Like that. Okay guys, that's all with our Ind AS 115.